Hello there, and welcome. I'm so glad you found your way here tonight. Before we begin, take a moment to get comfortable. Adjust your pillow, let your body settle into whatever position feels right. There's no rush. We have all the time in the world. Where in the world are you watching from? A quiet bedroom as the night deepens? A cozy corner where the weight of the day is finally lifting? Wherever you are, you're exactly where you need to be. Tonight we're going to explore the story of Wall Street, a narrow street in Lower Manhattan that became synonymous with American capitalism, with wealth and power, with dreams made and fortunes lost. We'll trace its journey from a simple meeting place under a buttonwood tree in 1792 through centuries of transformation, through panics and crashes and booms, to its emergence as the beating heart of global finance. We'll meet the people who built it, the forces that shaped it, and slowly, carefully, piece together how a single street came to hold such extraordinary power over the world's economic life. But don't worry. This isn't going to be a frantic recounting of financial chaos or a sensational exploration of greed. Instead, we'll move slowly and carefully through the centuries, through the deals and the innovations and the crises. We'll take our time with the stories, the quiet transformations and the dramatic moments. By the end, I think you'll find that Wall Street's story is really America's story, about ambition and innovation, about excess and correction, about how we've organized our economic life and what that says about who we are. If you enjoy these calm explorations of financial history, a like and subscribe really helps reach others seeking the same peaceful way to end their day. And to those already subscribed, thank you for being part of this community of thoughtful listeners. So settle in. Let your shoulders drop away from your ears. Take a slow breath, in through your nose, out through your mouth, and let's begin our slow drift through Wall Street's long history, from its earliest days to its current role at the center of the global economy. There's nowhere you need to be, no deadlines to meet. Just listen, and let the story unfold like a long, quiet conversation between old friends. Let it wash over you. If you drift away, that's perfectly fine. That's what we're here for. Let's begin in 1792, when America itself was young. The United States had only recently won its independence. The Constitution was just a few years old. George Washington was serving his first term as president. New York City, though already one of the young nation's most important ports, was still relatively small. Perhaps 33,000 people lived there. Clustered at the southern tip of Manhattan Island, the city ended at what is now Chambers Street. Beyond that lay farmland and woods. Wall Street itself was named for an actual wall, a wooden fortification built by Dutch colonists in 1653 to protect New Amsterdam from potential British invasion. The wall was long gone by the time of our story, torn down in 1799, but the name remained. It was a short street running east to west from the waterfront to a church, lined with merchants' houses and small businesses. Nothing particularly distinguished it from other streets in the bustling port district. But something was stirring in the new American economy. The Revolutionary War had been expensive, and the young federal government needed to manage debt to create financial systems that could support a growing nation. Alexander Hamilton, serving as the first Secretary of the Treasury, had bold plans. He wanted to assume state debts from the war to create a national bank, to issue government bonds that could be traded. These ideas were controversial. Thomas Jefferson and others feared they gave too much power to the federal government and to financial interests. But Hamilton prevailed. When Hamilton's plans were implemented, something remarkable happened. Suddenly there were securities to trade, government bonds, bank shares, bonds issued by states and cities. Previously there had been little organized financial trading in America. A few merchants might buy and sell shares in ships or trading ventures, but it was informal, occasional, small scale. Now there was enough volume to support regular trading. In the spring of 1792, a group of merchants and auctioneers began meeting regularly under a buttonwood tree on Wall Street to trade securities. We don't know exactly how many people participated in these early gatherings, perhaps 20 or 30. We know some of their names: Leonard Bleecker, Bernard Hart, Alexander Zuntz. They were merchants primarily dealing in various goods, but they saw opportunity in this new financial trading. The meetings under the buttonwood tree were informal, conducted outdoors when weather permitted. Traders would call out prices, make deals, record transactions in personal ledgers. There were no regulations, no formal structure, just merchants doing business as they'd always done, but now the commodity was paper. Certificates representing shares in banks or bonds issued by governments. On May 17th, 1792, 24 of these merchants and brokers signed an agreement that would, in retrospect, mark the beginning of organized securities trading in America. The document was simple, just 2 sentences. They agreed to trade securities only among themselves and to charge each other minimum commissions of 1/4%. That was all. No grand vision was articulated. No sense that they were founding an institution that would shape the world. Just a practical arrangement among businessmen to organize their trading and protect their profits. This was the Buttonwood Agreement. Name for the tree under which they'd been meeting. It wasn't legally sophisticated. It didn't create a formal organization immediately, but it established the principle that would define Wall Street ever after. Insiders trading among themselves, setting their own rules, protecting their collective interests. Let's pause for a moment and consider what was actually being traded in those early days. The securities market in 1792 was tiny by modern standards. The primary instruments were bonds issued by the federal government and bonds issued by individual states, Massachusetts, New York, Pennsylvania. There were also shares in the First Bank of the United States, Hamilton's creation, which had been chartered in 1791. A few insurance companies had tradable shares. That was essentially it. The volume of trading was small. On a busy day, perhaps a few $1,000s worth of securities changed hands. Prices were quoted in arcane fractions, eighths, sixteenths, 30-seconds, a system inherited from Spanish pieces of 8, the currency that had circulated in the colonies. The traders themselves were often doing this as a sideline to their main businesses. They were merchants who traded in goods, in ships' cargoes, in commodities, and also, increasingly, in these paper securities. Why Wall Street? Why did financial trading center on this particular location? Partly it was geographical convenience. Wall Street was near the waterfront where ships arrived with goods and information from Europe. It was near the customs house, where import duties were paid. It was in the heart of the merchant district, where commercial life concentrated. But partly it was accident, or at least contingency. The Buttonwood tree happened to be there. The initial meetings happened to occur there. And once a location becomes established for a particular activity, inertia tends to keep it there. The early securities market was deeply connected to government. Hamilton had designed it that way. Government bonds were the foundation of trading, the first bank of the United States. Though technically a private corporation, was essentially a quasi-governmental institution. The federal government owned 20% of its shares, and it served as the government's fiscal agent. From its very beginning, Wall Street and Washington were intertwined, mutually dependent, sometimes cooperative and sometimes antagonistic, but always connected. This connection would become a defining feature of American finance. In some countries, financial centers developed relatively independently of government, based on private commercial activity. In America, government policy and financial markets were linked from the start. This meant that political decisions in the new capital, first New York, then Philadelphia, then Washington, would ripple through Wall Street. And increasingly, Wall Street's interests would shape political decisions. The traders who signed the Buttonwood Agreement probably didn't think in these grand terms. They were businessmen making a practical arrangement. But they were also, without quite realizing it, creating something new, a formal, organized market for securities, a mechanism for channeling capital to where it was needed, a system that would grow to become the engine of American capitalism. By 1793, the Buttonwood traders had moved indoors to a coffee house on Wall Street called the Tontine. This was more comfortable, especially in winter, and it gave them a regular dedicated space. The Tontine Coffee House became Wall Street's first real trading floor. Merchants would gather, examine the latest price lists posted on the walls, negotiate deals, seal bargains with handshakes. The pace of life in these early markets was slow by modern standards. Information travelled at the speed of ships crossing the Atlantic. It might take 6 weeks to learn of events in London. Prices adjusted gradually. There was time to think, to consider, to consult. No one expected instant execution of trades. The market opened when traders felt like gathering, usually mid-morning, and closed when business was done, usually early afternoon. It was civilized, unhurried, almost leisurely. But even in these early innocent days, the seeds of later excesses were present. In 1792, just months after the Buttonwood Agreement was signed, the young American securities market experienced its first crash. The crisis centered on a speculator named William Dewar, who had been Assistant Secretary of the Treasury under Hamilton. Dewar had borrowed heavily to speculate in government bonds and bank shares, convinced that prices would keep rising. When they didn't, when prices began to fall, Dewar couldn't pay his debts. He was thrown into debtor's prison, and the panic spread. The crash of 1792 was small in absolute terms. The market was too tiny to cause widespread economic damage, but it established patterns that would repeat throughout Wall Street's history. Speculation driven by borrowed money, rising prices that seemed permanent until suddenly they weren't, panic when things reversed, the spreading of distress from speculators to the broader market. Even in miniature in this earliest crisis, we can see the dynamics that would shape later, much larger crashes. Hamilton, watching the panic, took action. He had the Treasury buy government bonds to support their price. This was improvised. There was no established doctrine about whether government should intervene in financial markets. But Hamilton instinctively understood that preserving confidence, maintaining stability, was important. His intervention helped stabilize the market. And it set another precedent. When financial markets were in trouble, government might step in to help. As the 1790s progressed, the market grew slowly but steadily. More securities became available, shares in new banks, bonds issued by growing states and cities, shares in turnpike companies and water companies. Trading became more regular, more professional. Men began to specialize as stockbrokers rather than treating it as a sideline. The Tontine Coffee House remained the center of trading, but the activity was spreading, becoming more organized. In 1817, the loose association of brokers formalized further. They adopted a constitution and created an organization called the New York Stock and Exchange Board. This was still a private club. You had to be elected to membership, and members enjoyed exclusive trading privileges. But it was more structured than the Buttonwood Agreement had been. There were rules about trading hours, about settlement procedures, about disputes among members. The amateurish informality of the Buttonwood days was giving way to something more systematic. The name is telling: Stock and Exchange Board. Not yet Stock Exchange. That would come later. The emphasis was on the board, on the collective governance by members. This was a cooperative arrangement among brokers, designed to serve their interests, to maintain their control over trading, to protect their profits from outside competition. The public could trade stocks only through these board members, who charged commissions for the service. It was a closed system, exclusive and self-regulating. Trading was still conducted by auction. A board member would call out the name of each listed security in turn, and brokers would shout out bids and offers. This call market system was orderly but slow. If you wanted to trade a particular stock, you had to wait until the auctioneer called that stock's name. Trades were recorded in ledgers by hand. Settlement, the actual transfer of securities and money, happened days later, with messengers carrying certificates and cash between offices. The securities being traded were changing too. Government bonds remained important, but increasingly trading focused on corporate stocks, shares in banks primarily, but also insurance companies, canal companies, early railroad companies. These represented claims on private enterprise, not government obligations. The market was evolving from a mechanism for handling public debt to a mechanism for raising capital for private business. This evolution would accelerate dramatically in the coming decades. The canal boom of the 1820s and 30s, the railroad boom that followed, the rise of industrial corporations after the Civil War, each wave brought new securities to market, new opportunities for profit, new risks of loss. Wall Street would grow with these developments, feeding on the capital needs of an expanding economy, becoming essential to American growth. But let's not race ahead. In the early 1800s, Wall Street was still small, still local, still relatively innocent. It was a place where merchants gathered to trade securities, using systems that weren't fundamentally different from those used to trade sugar or coffee. The great transformations, the explosive growth, the crashes and scandals and innovations that would make Wall Street famous and infamous. All that lay ahead. For now, it was just a street in Lower Manhattan, home to a small club of brokers, buying and selling paper, building the foundations of something they couldn't yet imagine. Let that image settle for a moment. The Tontine Coffee House, the called names of securities, the handshake deals, the careful ledger entries, the slow pace, the small scale. This was Wall Street in its youth, before it became the centre of American finance, before it gained the power to shake the world. It was a beginning, modest and tentative, but a beginning nonetheless. As we move into the middle decades of the 19th century, Wall Street began its transformation from a local marketplace into something more powerful, more essential to the American economy. This transformation wasn't sudden or dramatic. It happened gradually, through the accumulation of many small changes, through the demands of a growing nation, through the opportunities created by new technologies and new forms of enterprise. The 1830s and 40s were decades of extraordinary economic expansion in America. The population was growing rapidly, from about 13 million in 1830 to 23 million by 1850. The country was pushing westward, acquiring new territories, settling new lands. This expansion required infrastructure, roads, canals, bridges, eventually railroads, and infrastructure required capital, enormous amounts of it, more than any individual or small group could provide. This is where Wall Street became crucial. The stock and bond markets provided a mechanism for gathering capital from many investors and directing it toward large projects. A canal company or railroad could issue bonds, promising to repay investors with interest. These bonds could be sold to wealthy individuals, to banks, to institutional investors. The money raised could fund construction. Later, when the project generated revenue, bondholders would be repaid. The system worked, at least in theory, to connect those who had capital with those who needed it for productive purposes. The Erie Canal, completed in 1825, demonstrated both the possibilities and the financial mechanics of large infrastructure projects. The canal stretched from Albany to Buffalo, more than 350 miles, connecting the Hudson River to Lake Erie. It was funded primarily by bonds issued by New York State. These bonds were sold to investors, many of them in Europe, particularly in Britain and the Netherlands, where there was capital-seeking investment opportunities. The canal was a spectacular success, dramatically reducing shipping costs and enriching New York City, which became the primary port for goods moving between the interior and the Atlantic. The bonds were repaid from canal tolls, investors made money, New York prospered, and the model was established. Following the Erie Canal's success, canal fever swept America. States and private companies rushed to build canals, each promising to replicate Erie's profitability. Bonds were issued by the hundreds. Wall Street brokers found themselves handling an ever-increasing volume of securities. Not all of these canals succeeded. Many were poorly planned, built in the wrong locations, or simply arrived too late. The railroad was already emerging as a superior technology. When canals failed to generate expected revenues, bonds defaulted, investors lost money, states struggled with debt they couldn't repay. This boom and bust cycle in canal securities taught Wall Street important lessons about risk and speculation. Not every opportunity was as good as it looked. Projections of future revenue were often wildly optimistic. The promoters of projects had incentives to exaggerate potential returns. Investors needed to be skeptical, to investigate claims, to understand the actual prospects of the enterprises they were funding. Of course, these lessons were often forgotten in the excitement of the next boom, but they were learned and relearned through painful experience. The railroad would prove even more consequential for Wall Street than the canal had been. The first American railroads were built in the 1830s, short lines, experimental ventures, often just a few miles long. But the potential was obvious. Railroads could go where canals couldn't. They could operate year-round, unlike canals that froze in winter. They were faster. As technology improved, they became more reliable and less expensive to build. By the 1840s, railroad construction was accelerating. By the 1850s, it had become a mania. Railroads were being projected across the entire country. Every region wanted rail connections. Every city wanted to be a railroad hub. The capital requirements were staggering. A single railroad might cost millions of dollars to build, sums far beyond what any individual or small group could provide. This meant securities, lots of securities, railroad bonds, railroad stocks, preferred shares, convertible bonds. Financial engineers created increasingly complex instruments to attract different types of investors with different risk tolerances. Wall Street was the natural center for trading these railroad securities. The New York Stock and Exchange Board handled most of the trading in major railroad stocks and bonds. Brokers specialized in railroad securities, developing expertise in evaluating different companies, different routes, different financial structures. Investment banks emerged to underwrite new securities issues, to buy bonds or stocks from railroad companies and then resell them to investors, taking a profit on the spread. This underwriting function would become central to Wall Street's role in the economy. Let's think about what this meant in human terms, in practical terms. A railroad company, say the New York and Erie, which was being built to connect New York City with Lake Erie, needed to raise capital. The company would approach an investment bank, perhaps one of the private banking houses that were becoming prominent. The bank would agree to buy bonds from the railroad at one price and sell them to investors at a slightly higher price. The bank took the risk that it might not be able to find buyers for all the bonds, but it also stood to make significant profit if it could sell them successfully. To sell the bonds, the bank needed to convince investors that the railroad would succeed, would generate enough revenue to pay the promised interest and eventually repay the principal. This required investigation, analysis, marketing. The bank would prepare prospectuses describing the railroad's route, its expected traffic, its financial projections. These prospectuses were often more optimistic than realistic, emphasizing potential while downplaying risks. But investors, hungry for returns and excited by the romance of railroads, were often willing to believe. The bonds would be sold to various buyers. Some went to wealthy American investors. Others were sold in Europe, where British and European investors were eager to participate in American growth. By the 1850s, European investors held enormous quantities of American railroad securities. This created connections between Wall Street and European financial centers, particularly London, that would grow deeper over time. Wall Street was becoming integrated into global capital markets, serving as the gateway through which European capital flowed into American development. Trading in these securities was becoming more sophisticated and more intense. The Stock and Exchange Board's call market system was struggling to handle the volume. In 1853, the board moved to a larger space at what would become famous as 11 Wall Street. The new trading floor could accommodate more brokers, more activity. But even this wasn't enough. Outside the Stock and Exchange Board, informal trading was occurring. Brokers who weren't board members, or who wanted to trade securities not listed by the board, would gather on the street itself, on the curb outside the board's building, calling out prices and making deals. This curb market was chaotic and unregulated, but it handled real volume and real money. The 1850s also saw the emergence of specialized financial newspapers that reported stock prices and financial news. These papers served traders who needed information, who wanted to track prices, who were following particular companies or sectors. The availability of this information made markets more transparent, but it also accelerated trading, intensified speculation, created feedback loops where news moved prices and moving prices created news. Not everything that happened on Wall Street in these decades was about railroads and legitimate investment. There was manipulation, fraud, insider dealing from the very beginning. Stock pools, groups of traders who would coordinate to drive a stock's price up, then sell at the peak, were common. Brokers would spread false rumors to influence prices. Company officers would manipulate information to benefit themselves. The 19th century securities markets were essentially unregulated. There were no disclosure requirements, no insider trading laws, no government oversight. The principle was caveat emptor, let the buyer beware. If you were foolish enough to believe a stock tout or to buy without investigating, you deserved to lose your money. This lawlessness created opportunities for the clever and ruthless. Cornelius Vanderbilt, who had made his first fortune in steamships, moved into railroads in the 1860s and proved to be a master of financial manipulation. He would quietly accumulate shares in a railroad, gain control of the board, then drive the stock price higher through various means, announcing dividends, spreading optimistic news, coordinating with friendly brokers. Once the price was high, he might sell shares to take profits, or he might consolidate his control and actually run the railroad as a profitable business. He did both, depending on circumstances. The Civil War, which began in 1861, had profound effects on Wall Street and American finance. The war's cost was enormous. The Union government alone spent more than $3 billion, a sum that dwarfed all previous government expenditures. This money had to be raised, and it was raised primarily through bonds. The Union issued bonds in unprecedented quantities, bonds that were sold to American investors and, crucially, to European investors who were betting on Northern victory. Wall Street brokers handled much of this bond trading. The war was terrible, devastating, tragic, but it was also, from a narrow financial perspective, profitable for those who traded successfully in government bonds. Prices fluctuated based on military news. A Union victory would send bond prices up. A Confederate victory would push them down. Traders who could get news quickly, who could interpret military developments correctly, could make fortunes. The war also saw the creation of a new currency system. Previously, American money had been chaotic. Various banks issued their own notes, and there was no unified national currency. In 1862, the Union government began issuing paper money, called greenbacks, that would serve as legal tender throughout the North. This standardized currency made financial transactions easier, more efficient. It also created a new commodity to trade. Greenbacks themselves fluctuated in value relative to gold, and traders could speculate on this fluctuation. After the war ended in 1865, the American economy entered a period of explosive growth. The Transcontinental Railroad was completed in 1869, linking the Atlantic and Pacific coasts. Industry was expanding rapidly. Immigration was surging. Millions of Europeans arrived in these decades, providing labor for factories and farms. Cities grew at unprecedented rates. The country was being transformed from a primarily agricultural society to an industrial one. This transformation created opportunities for Wall Street because industrial companies needed capital just as railroads had. A steel mill, an oil refinery, a meatpacking plant, these required significant investment in equipment and facilities. Corporations were formed to operate these businesses, and corporations issued stocks and bonds to raise capital. The securities markets, previously dominated by government bonds and railroad securities, now included industrial securities as well. But the growth wasn't smooth or steady. The economy experienced severe panics and depressions in this period. The Panic of 1857 had been serious but relatively short. The Panic of 1873 was catastrophic, triggering a depression that lasted more than 5 years. The immediate cause was the failure of J. Cook and Company, a prominent investment bank that had overextended itself in railroad financing, particularly in the Northern Pacific Railway. When Cook's firm failed, panic spread through Wall Street. Stock prices collapsed. Banks failed. Credit evaporated. The Panic of 1873 revealed the fragility of the financial system. Everything was connected. When a major bank failed, it couldn't meet its obligations to other banks, which then faced their own crises. When stock prices fell, investors who had borrowed money to buy stocks faced margin calls and were forced to sell, driving prices lower still. The mechanisms that had seemed to work smoothly when confidence was high broke down rapidly when confidence evaporated. In the depression that followed the panic, unemployment rose to levels that seemed shocking at the time. Though they would be exceeded in later crises, factories closed, railroads went bankrupt. By some estimates, more than 1/4 of railroad mileage was in receivership during the 1870s. Workers suffered. Farmers struggled with low crop prices. There were labour strikes, some of them violent, as workers fought for better wages and conditions. Wall Street weathered the storm, though not without casualties. Some brokerage firms failed, some traders were ruined, but the infrastructure remained: the stock exchange, the investment banks, the networks of traders and brokers. When recovery began, Wall Street was positioned to benefit. and the panic taught lessons. At least temporarily. Investors became more cautious about railroad securities. Banks became more careful about lending. The exuberance that had characterized the pre-panic years gave way to something more sober and considered. Through all of this, Wall Street's physical location remained remarkably constant. The financial district was still concentrated in a few blocks of Lower Manhattan, centered on Wall Street itself. The Stock Exchange building at 11 Wall Street was the symbolic and actual heart of securities trading. Around it clustered the offices of brokers, investment banks, commercial banks, law firms serving financial clients. This geographic concentration created advantages. Information spread quickly, face-to-face meetings were easy, relationships formed naturally. But it also created vulnerability. When panic struck, it could spread rapidly through the concentrated community. The culture of Wall Street was evolving too. In the early days, brokers had been merchants who traded securities as one business among others. By the post-Civil War era, Wall Street was becoming professionalized. Men made careers as brokers or bankers, specializing in finance rather than treating it as a sideline. A Wall Street career became prestigious, potentially very lucrative, attractive to ambitious young men from both wealthy families and more modest backgrounds. The opportunity for rapid enrichment drew talent and energy, but it also created a culture that was intensely competitive, sometimes ruthless, focused on profit often to the exclusion of other considerations. The social Darwinism that was intellectually fashionable in the late 19th century, the idea that competition was natural and that success proved fitness, found fertile ground on Wall Street. The men who succeeded in finance saw themselves as the fittest, the most capable, deserving of their wealth. Those who failed had simply proven themselves unequal to the challenge. This ideology justified behavior that might otherwise have been questioned. If markets were natural arenas of competition, then manipulation and sharp practices were just part of the game. If success proved merit, then the wealthy deserved their wealth, and the poor deserved their poverty. These ideas were convenient for those who benefited from the system, and they shaped Wall Street culture for generations. As the 1800s drew toward their close, Wall Street stood at a threshold. It had grown from a small club of brokers trading under a tree to a complex, sophisticated financial center that was essential to the American economy and increasingly connected to global markets. The securities traded there represented the railroads that crossed the continent, the industries that were transforming American life, the government bonds that had financed a civil war and would finance future endeavors. The techniques of modern finance, underwriting, trading, speculation, manipulation, were all present, if not yet fully developed. The next decades would bring even more dramatic growth and change. Wall Street would finance the great industrial corporations that would dominate the American economy. It would experience crashes that made earlier panics look mild. It would produce individuals of legendary wealth and power. It would become, truly, the center of American capitalism, the mechanism through which capital was allocated, fortunes made and lost, the economic life of the nation organized. But let's pause here. In the 1870s and 80s, when Wall Street had achieved importance but not yet dominance, when it was powerful but not yet overwhelmingly so. Picture the trading floor, the shouting brokers, the slate boards with chalk prices, the messengers running with slips of paper. The ticker tape machines that had recently been introduced and were starting to revolutionize information flow. Picture the ambitious young men arriving from all over America and even from Europe, drawn by the promise of wealth, ready to test themselves in this arena. Picture the established bankers in their offices, making decisions that would move millions of dollars, shape industries, determine which railroads would succeed and which would fail. This was Wall Street finding its voice, discovering its power, learning what it could do. The full implications wouldn't be clear for decades more, but the trajectory was set. A narrow street in Lower Manhattan had become the center of American finance, and American finance was becoming central to the world. Let that image settle for now. The growing power, the increasing complexity, the opportunities and dangers that came with Wall Street's rise. We'll continue the story, but there's no rush. The history will wait. Rest if you need to. We have time. The final decades of the 19th century and the opening years of the 20th saw the rise of individuals who would come to personify Wall Street power. men whose names became synonymous with American capitalism, whose fortunes were so vast they seemed almost unimaginable, whose influence extended far beyond finance into politics, industry, and culture. These were the years of what Mark Twain called the Gilded Age, when spectacular wealth accumulated in fewer and fewer hands, when Wall Street financiers became titans who could make or break entire industries. John Pierpont Morgan stands at the centre of this story. Born in 1837 into a banking family, his father, Junius Spencer Morgan, ran a successful merchant bank in London. J.P. Morgan seemed destined for finance from birth. He was educated in Europe, trained in banking houses in London and New York, and by the 1870s had established himself as one of Wall Street's most powerful figures. What distinguished Morgan wasn't just his wealth, though that was considerable, but his ability to organise, to impose order on chaos, to command respect and even fear from other powerful men. Morgan understood something crucial about the industrial economy that was emerging in America. Competition, carried to its logical extreme, was destructive. When too many railroads competed for the same routes, when they cut rates to drive each other out of business, when they built redundant lines and wasted capital, everyone suffered. Investors lost money, the railroads themselves became unstable, even the public suffered from unreliable service. What was needed, Morgan believed, was consolidation, organisation, stability. Competition should be managed, directed, controlled. He put this philosophy into practice through what became known as, quote, 3. When a railroad was in financial trouble, struggling with debt, or poor management or ruinous competition, Morgan would step in. He would reorganize the railroad's finances, often forcing bondholders to accept losses, replacing incompetent management with people he trusted, sometimes merging the troubled railroad with stronger competitors to create more efficient systems. In exchange for this service, Morgan would place his representatives on the railroad's board, ensuring his continued influence. By the 1890s, Morgan or his representatives sat on the boards of many of America's major railroads. This was power of a kind America hadn't seen before. Morgan wasn't a government official, he held no elected position, answered to no voters. But he could determine the fate of industries that employed hundreds of thousands of workers, that moved millions of tons of freight, that were essential to the functioning of the economy. When Morgan made decisions about railroad financing or reorganization, those decisions affected the entire country, and he made them based on his judgment of what would be profitable, what would be stable, what would serve his interests and those of his clients. The power Morgan accumulated created both admiration and resentment. Business leaders respected his ability to bring order to chaos, to organize complex financial arrangements, to maintain stability when others panicked. They valued his word. Morgan was known for keeping his commitments, for being reliable in a world where many weren't. A deal sealed with Morgan's handshake was considered as solid as any written contract. This reputation for integrity, even as he wielded enormous power, was part of what made him effective. But others saw Morgan as a threat to democracy, to competition, to the American ideal of opportunity for all. If a small group of bankers could control major industries, could determine which companies succeeded and which failed, could accumulate wealth and power far beyond what any individual should have, then what did that mean for the Republic? Populist movements in the 1880s and 90s, particularly strong among farmers and workers, railed against Wall Street, against the money power, against what they saw as the plutocracy that was strangling American democracy. Morgan wasn't the only titan of this era. There was Jay Gould, perhaps the era's most notorious stock manipulator, who made and lost fortunes through schemes that enriched himself while devastating other investors. Gould understood that controlling information meant controlling prices. He would plant false stories in newspapers, coordinate with other traders to manipulate stock prices, engage in insider trading that was legal at the time but deeply unethical. He died in 1892, one of the richest men in America, widely hated but financially triumphant. Edward Harriman built a railroad empire stretching across the continent. Jacob Schiff, head of the investment bank Kuhn, Loeb and Company, rivaled Morgan in power and was particularly important in financing railroad expansion. These men competed and occasionally cooperated, forming temporary alliances when it suited them. breaking those alliances when interests diverged. The intricate dance of cooperation and competition among Wall Street's elite shaped American industrial development. The 1890s brought another severe financial crisis, the Panic of 1893. The immediate trigger was the failure of several major railroads, including the Philadelphia and Reading Railroad and the Northern Pacific Railway, along with the bankruptcy of numerous smaller banks. But the underlying causes were deeper: overexpansion of railroads, excessive debt, declining agricultural prices that hurt farmers' ability to pay freight charges, uncertainty about whether America would maintain the gold standard for its currency. The panic was severe. The stock market crashed. Banks failed by the hundreds. Some 500 banks closed in 1893 alone. Unemployment rose to estimates ranging from 15 to 20%. Strikes erupted as workers fought wage cuts. The Pullman strike of 1894 paralysed railroad traffic across much of the country and had to be broken by federal troops. The depression that followed the panic lasted 4 years, bringing widespread suffering. In the midst of this crisis, Morgan played a role that was extraordinary and controversial. In 1895, the federal government's gold reserves were being depleted as investors, nervous about America's commitment to the gold standard, were exchanging paper currency for gold and shipping it abroad. The Treasury was approaching the point where it wouldn't have enough gold to maintain the currency's convertibility. This threatened to trigger an even worse crisis. If America abandoned the gold standard, it would devastate international confidence in American securities and potentially cause a complete financial collapse. President Grover Cleveland, a Democrat who believed firmly in sound money and the gold standard, faced a terrible choice. Congress wouldn't authorize a bond issue to replenish the gold reserve. Too many populists and silver advocates opposed it, but without gold, the currency system would collapse. Cleveland turned to Morgan. Morgan, along with August Belmont representing the Rothschild banking interests in Europe, agreed to organize a private bond purchase. They would buy $62 million in government bonds, paying for them in gold, replenishing the Treasury's reserves. In return, they would be able to resell the bonds to investors at a profit. The arrangement saved the gold standard and probably prevented a complete financial collapse. But it also looked like the government was dependent on private bankers, like Morgan was more powerful than elected officials. Critics were outraged that private financiers had bailed out the government and profited from doing so. Morgan saw it differently. He had used his resources and his international connections to solve a crisis that the political system couldn't address. He had prevented catastrophe. Yes, he profited. That was how the system worked, how private enterprise operated. But the alternative would have been far worse for everyone. This was Morgan's self-conception. He was a stabilizing force, using his power and wealth to maintain order when lesser men couldn't. The 1890s also saw the beginning of a transformation that would reshape American industry and give Wall Street even greater power. This was the Great Merger movement, when many separate companies in the same industry combined to form enormous corporations that dominated entire sectors. The steel industry, the oil industry, railroads, meatpacking, farm equipment all saw waves of consolidation that created giant corporations. Morgan was central to this process, particularly in steel. The steel industry in 1900 consisted of many competing companies, the largest and most efficient being Carnegie Steel, owned by Andrew Carnegie. Carnegie was a different type of capitalist than Morgan. He had built his fortune by operating businesses efficiently, cutting costs, producing more for less. He wasn't primarily a financier. But by 1900, Carnegie was old and thinking about retirement. He was willing to sell. Morgan saw an opportunity to create the ultimate consolidation in steel, a single corporation that would control the entire process from iron ore mines through steel production to finished products. In 1901, Morgan organized the formation of United States Steel Corporation, buying out Carnegie and combining his company with several competitors. The price paid to Carnegie alone was $480 million, making him spectacularly wealthy even by Gilded Age standards. The total capitalization of U.S. Steel was $1.4 billion, making it the world's first billion-dollar corporation. United States Steel controlled about 67% of American steel production. It owned mines, ships to transport ore, railroads to move materials, factories to produce steel, and manufacturing facilities to turn steel into finished products. It employed more than 160,000 workers. It was vertically integrated and enormous in a way no corporation had been before. And it had been created not by someone building a business from the ground up, but by a financier organizing a merger, buying existing companies with money raised by selling securities to investors. This was the new model: Wall Street creating corporations through financial engineering rather than industrial development, creating corporations that then needed Wall Street's services. The distinction matters. When industrialists built businesses and then came to Wall Street for capital, the businessmen remained in control. When Wall Street financiers organized corporations by merging existing companies, buying them with borrowed money and stock issues, the financiers controlled the result. Power was shifting from industry to finance. The creation of these enormous corporations raised questions that America struggled to answer. Were such concentrations of economic power acceptable in a democracy? Did they represent efficient organization of resources, or monopolistic control that would exploit consumers and workers? Should government regulate them, break them up, or leave them alone? These questions sparked intense political debate. The progressive movement, which gained strength in the early 1900s, argued that these corporate combinations threatened American democracy and required government action. Trust-busting became a political cause. Theodore Roosevelt, who became president in 1901 after William McKinley's assassination, made his reputation partly by challenging corporate power, though his actual policies were more moderate than his rhetoric suggested. In 1907, Wall Street experienced another panic, this one particularly frightening because it seemed to threaten the entire banking system. The immediate cause was the failure of the Knickerbocker Trust Company, one of New York's largest trust companies. Trust companies had grown rapidly in the previous decades, offering many of the same services as banks but with less regulation. When the Knickerbocker Trust failed in October 1907, panic spread. Depositors rushed to withdraw money from other trust companies and banks, fearing they might fail too. This was the classic bank-run dynamic. Even sound institutions couldn't survive if all depositors demanded their money simultaneously, because money was lent out, not sitting in vaults. As runs spread, more institutions failed, which triggered more runs, creating a vicious spiral. The New York Stock Exchange was on the verge of closing because brokerage firms couldn't get credit to finance their operations. The financial system was approaching complete breakdown. There was no central bank in America at this time. The Second Bank of the United States had been killed by Andrew Jackson in the 1830s, and no replacement had been created. The federal government had no mechanism to inject money into the banking system, to serve as a lender of last resort, to stop the panic. If the crisis was to be solved, private action would be necessary. Morgan, now 70 years old, took charge. He essentially functioned as a one-man central bank. He gathered the leading bankers of New York in his library, literally in his personal library at his mansion on Madison Avenue, and organized a response. Money was pooled to shore up threatened institutions. Morgan himself examined the books of various trust companies to determine which were sound and deserved support, and which were hopeless and should be allowed to fail. He arranged for money to flow to the stock exchange to prevent its closure. He persuaded other wealthy men to deposit money in threatened banks to prevent runs. The crisis lasted weeks. Morgan worked through nights, making decisions about which institutions to save, organizing credit arrangements, using his authority and his reputation to maintain confidence. At one critical moment, with the stock exchange about to close for lack of funds, Morgan raised $25 million in 15 minutes through his connections and his personal authority. Men gave him money because he asked, because they trusted his judgment, because they knew he would use it effectively. The panic was eventually contained. The financial system survived. But the 1907 crisis made clear something that thoughtful observers had understood for some time. Relying on a single private banker, no matter how capable or public-spirited, to serve as the financial system's backstop was not a sustainable arrangement. What if Morgan had been ill, or dead, or simply less effective? What if his interests had diverged from the public interest? The country needed institutional mechanisms, government-backed systems, to prevent and respond to financial panics. This realization led, eventually, to the creation of the Federal Reserve System in 1913. The Federal Reserve was America's third attempt at a central bank, designed to provide the banking system with elasticity, the ability to expand credit during crises, to serve as lender of last resort, to prevent panics through systematic rather than improvised responses. The creation of the Fed represented a significant shift in thinking about financial regulation and the government's role in managing the economy. But the Fed's creation also marked a transition in Wall Street's relationship with government. Previously, Wall Street had operated with minimal government oversight, regulated mainly by its own customs and by state laws that were often weak. The Fed's creation meant federal involvement in banking, federal supervision, federal power to influence credit conditions. This wasn't comprehensive regulation. Securities markets remained largely unregulated until the 1930s, but it was a beginning. J.P. Morgan died in Rome in March 1913, just months before the Federal Reserve Act was signed into law. His death marked the end of an era. The kind of personal dominance Morgan had exercised, individual banker as ultimate authority, private power substituting for public institutions, wouldn't be possible in the same way afterward. Power would become more institutionalized, more diffused, more subject to government involvement. But Morgan's legacy was profound. He had demonstrated that finance could create and control industry, that organizing and reorganizing companies and industries through mergers and acquisitions could generate enormous profits, that Wall Street could be not just a marketplace for securities, but a source of power over the real economy. The investment banking model he developed, underwriting securities, organizing mergers, placing representatives on corporate boards, would continue to define Wall Street practice for generations. The years from the 1870s through 1913 had transformed Wall Street from an important securities market to the command center of American capitalism. The financiers who operated there had accumulated wealth and power that would have been unimaginable to the buttonwood traders. They had created enormous corporations, organized entire industries, intervened in national crises, shaped the development of the American economy. They had also generated resentment and opposition, sparked political movements demanding regulation and reform, raised questions about the relationship between economic power and democracy that remained unanswered. As we pause here, in 1913, with Morgan dead and the Federal Reserve being born, Wall Street stood at a pivot point. Behind it lay decades of explosive growth and increasing power, of titans who seemed to bestride the economy like giants, of panics and recoveries and transformations. Ahead lay the First World War, which would make Wall Street a creditor to the world. Then the Roaring Twenties and the Great Crash. Then the New Deal regulations. Then the post-war boom and the long, slow transformation into the globalized financial system we know today. But let's rest here for a moment. Picture Morgan's library where decisions affecting millions of people were made by a small group of men in a private room. Picture the stock exchange floor, where fortunes were made and lost in minutes. Picture the offices of the great investment banks, where young men worked to create the deals that would reshape industries. This was Wall Street at the height of the Gilded Age, powerful and confident, necessary and dangerous, admired and feared. Let that image settle. We'll continue the story. But there's no hurry. The past is patient. It will wait for us. The First World War, which began in Europe in August 1914, would transform Wall Street's role in the global economy in ways that no one could have anticipated when the first shots were fired. America remained neutral for the first 3 years of the conflict, but neutrality didn't mean isolation, and it certainly didn't mean Wall Street stayed on the sidelines. Instead, the war created opportunities for American finance that would reshape the international financial order and establish New York as a rival to London, which had been the world's financial center for more than a century. When war broke out, the European powers, Britain, France, Germany, Russia, Austria-Hungary, were relatively evenly matched in industrial capacity and military strength. Everyone expected the war to be short, perhaps over by Christmas of 1914. Instead, it settled into a grinding stalemate, with armies facing each other across trenches that stretched from the English Channel to Switzerland. This kind of war, industrial war, war of attrition, consumed resources at a rate no one had imagined possible. Shells, rifles, uniforms, food, vehicles, fuel, everything had to be manufactured, transported, supplied in enormous quantities. The Allied powers, primarily Britain and France, had the advantage of access to the Atlantic and therefore to American industry and American resources. They could buy what they needed from the United States, could place orders for weapons and ammunition, could purchase food and raw materials. But they needed to pay for these purchases, and as the war dragged on month after month, year after year, their financial resources became strained. Gold reserves were depleted. The normal sources of revenue couldn't keep pace with wartime expenditures. They needed credit, they needed loans, and Wall Street was ready to provide them. J.P. Morgan and Company, now led by Jack Morgan, J.P. Morgan's son, after the elder Morgan's death, became the primary American agent for British and French purchasing. This was an extraordinary role. The Allied governments would place orders through Morgan's firm, which would then contract with American manufacturers to produce what was needed. Morgan and Company essentially organized a significant portion of the American war economy on behalf of foreign governments, coordinating production, arranging shipping, managing payments. The commissions on these transactions were enormous, making the Morgan firm even wealthier than it had been. But beyond these commercial transactions, there was the question of lending. The Allied powers needed to borrow money to finance their purchases, and they wanted to borrow from American investors. Initially, the Wilson administration discouraged such loans, believing they compromised American neutrality. William Jennings Bryan, Wilson's Secretary of State, argued that money is the worst of all contrabands because it commands everything else. If American investors lent money to Britain and France, America's economic interest would become tied to Allied victory, making true neutrality impossible. But the economic logic was powerful. American industry was producing goods for the Allies, creating jobs, generating profits. If the Allies couldn't borrow money to continue buying American goods, orders would dry up, factories would close, unemployment would rise. The Wilson administration quietly backed away from its opposition to loans. By 1915, American banks were lending to Allied governments, first in smaller amounts, then in sums that reached into the hundreds of millions of dollars. The loans were structured as bonds, sold to American investors. An Allied government, say Britain, would issue bonds promising to repay the loan with interest. Wall Street investment banks would underwrite these bonds, buying them from the British government and reselling them to American investors. The bonds were marketed as safe investments, backed by the full faith and credit of major European powers, and they were attractive. They paid higher interest rates than most domestic American bonds, compensating for the risk that the Allies might lose the war and be unable to repay. By 1917, when America entered the war, Allied governments owed American lenders approximately $2,300,000,000. This was an astonishing sum, representing a dramatic shift in international financial relationships. Before the war, America had been a debtor nation. European investors, particularly British investors, owned large amounts of American securities, particularly railroad bonds. American development had been partly financed by European capital, but the war reversed this relationship. Now America was a creditor. European powers owed money to American lenders, and this would have profound long-term consequences. When America entered the war in April 1917, the financial relationship intensified. Now the US government itself was lending to the Allied governments through Liberty loans. The Treasury issued Liberty bonds to American citizens, raising money that was then lent to Britain, France, and other allies to help finance their war efforts. These Liberty bond drives were massive public campaigns, using advertising, celebrity endorsements, social pressure to convince Americans to buy bonds. It worked. Millions of ordinary Americans bought Liberty bonds, lending their savings to the government to help win the war. Wall Street played a crucial role in these bond drives, underwriting and distributing the securities, organizing the sales campaigns. The experience of selling bonds to a mass market, not just to wealthy investors but to middle-class and even working-class Americans, taught Wall Street techniques that would be used in the 1920s to sell corporate securities to an increasingly broad investing public. The war democratized securities ownership bringing millions of people into markets who had never invested before. The war also disrupted international financial markets in ways that benefited New York. London had been the world's financial centre, the place where international transactions were settled, where currencies were exchanged, where international loans were organised. But the war made London vulnerable. German submarines threatened Atlantic shipping, making transactions risky. Britain's financial resources were strained by war costs. Capital controls restricted movements of money. New York, safely distant from the fighting, became an alternative financial centre, a place where international business could be conducted more easily than in war-torn Europe. The establishment of the Federal Reserve System in 1913 proved fortuitous timing. The Fed could discount trade acceptances, a form of credit used in international commerce, making it easier for American banks to finance international trade. This helped New York compete with London for international business. The Fed could also serve as a lender of last resort, providing stability that made New York attractive to international investors. The institutional infrastructure that had been created to prevent domestic financial panics also helped New York rise as an international financial centre. By the time the war ended in November 1918, the international financial landscape had been transformed. European powers had accumulated enormous debts, both to their own citizens and to foreign lenders, particularly Americans. European currencies had been inflated by war spending. European economies had been distorted by wartime production, with resources directed to military needs rather than civilian goods. The pre-war international financial system, based on the gold standard and British financial dominance, was shattered. America, by contrast, emerged from the war economically strengthened. American industry had expanded to meet wartime demand. American agriculture had prospered, feeding Allied populations. American banks had accumulated gold as European powers paid for American goods. New York had established itself as a major international financial centre. The transition from debtor to creditor nation was complete. Now European powers owed America, and this creditor position gave America economic power it had never possessed before. The question was what America would do with this power, how it would manage the transition to being the world's leading economic and financial power. This question would shape the 1920s and have consequences that extended far beyond. But the answers weren't immediately clear. American political culture had been shaped by a century of relative international isolation, of focusing on continental expansion rather than global involvement. There was no consensus about what international economic leadership meant or required. The immediate post-war years were economically turbulent. There was a brief but sharp recession in 1920 to 1921 as the economy adjusted from wartime production to peacetime activity. Soldiers returning from Europe needed jobs. Factories that had produced weapons needed to convert to civilian production. Agricultural prices, which had been high during the war when Europe needed American food, fell as European agriculture recovered. Unemployment rose. Businesses failed. There were labour strikes as workers fought to maintain wartime wage gains. Wall Street experienced volatility during this adjustment. Stock prices fell sharply in 1920 as recession hit. Some of the companies that had prospered during wartime struggled in peace. Investors who had bought stocks at wartime peaks saw their holdings lose value, but the recession was relatively short. By 1922, recovery was underway, and the stage was being set for what would become the great bull market of the 1920s. The 1920s would be extraordinary years for Wall Street, years of explosive growth in stock prices, of widespread public participation in securities markets, of innovation in financial techniques and instruments. But they would also be years that would end in catastrophe, in the great crash of 1929 and the depression that followed. As we approach those famous years, it's worth pausing to consider what had changed, what Wall Street had become by the early 1920s. Wall Street was no longer just a domestic securities market serving American companies and investors. It was an international financial centre connected to London, Paris, Berlin, Tokyo, handling international loans and currency transactions. Serving as a link between American capital and global opportunities. The war had accelerated this internationalization, but it would continue through the 20s as American banks and investors looked abroad for opportunities. Wall Street had also become more technically sophisticated. The ticker tape, which had been introduced in the 1860s, now provided nearly real-time price information to traders across the country. Telephone and telegraph connected New York to regional markets and to Europe. Statistical analysis was becoming more common. Investors were beginning to look at price-earnings ratios, dividend yields, balance sheet metrics, rather than relying purely on tips and rumours. Professional securities analysis was emerging as a discipline. The range of securities being traded had expanded. Beyond railroad bonds and stocks, which had dominated 19th century trading, there were now industrial stocks, shares in manufacturing companies, oil companies, retail chains, automobile manufacturers. There were utility stocks, electric power companies, telephone companies, gas suppliers. There were investment trusts, which were essentially mutual funds, allowing small investors to buy shares in diversified portfolios. The market was becoming more diverse, more complex. But Wall Street was also becoming more accessible to ordinary Americans. Before the war, stock ownership had been limited primarily to the wealthy. By the early 1920s, middle-class Americans were buying stocks in increasing numbers. Brokerage firms opened branch offices in cities across the country, not just in New York. Advertising encouraged investment, installment buying, purchasing stocks on margin, paying only a fraction of the price up front and borrowing the rest, made it possible to invest with limited capital. The barriers to entry were falling. This democratization of investing was celebrated as a positive development. It meant more Americans could participate in capitalism, could own shares in the companies where they worked or whose products they bought, could build wealth through investment. The idea that stock ownership should be widespread, that capitalism should be democratic rather than plutocratic, was appealing. It seemed to promise a more equitable distribution of wealth, a society where workers could become capitalists. But this democratization also created vulnerabilities. When investing had been limited to the wealthy, market crashes hurt primarily those who could afford losses. When millions of ordinary Americans owned stocks, when their savings were invested in markets, crashes would devastate the middle class. When buying on margin was widespread, price declines would trigger margin calls, forced selling, cascading crashes. The same developments that made investing more accessible also made markets more dangerous. The regulatory framework remained minimal. The Federal Reserve regulated banks, but securities markets were largely self-regulated. The New York Stock Exchange had its own rules for member firms, but these were designed primarily to maintain orderly trading among professionals, not to protect ordinary investors. There were no requirements for companies to disclose financial information, no rules against insider trading, no limits on market manipulation. The principle was still caveat emptor. If you chose to invest, you took your chances. If you were defrauded or manipulated, that was unfortunate. But it wasn't the government's concern. This lack of regulation reflected the dominant ideology of the time. The 1920s were years of Republican dominance in Washington. Harding, Coolidge, Hoover all believed in limited government, in letting business operate with minimal interference. The idea that government should regulate securities markets, should protect investors, should limit speculation. These ideas had some support, particularly among progressives and reformers, but they weren't politically dominant. The prevailing view was that markets worked best when left alone, that regulation would be inefficient and would stifle the innovation and growth that made American capitalism dynamic. Wall Street's leaders generally agreed with this view. They saw themselves as the guardians of capitalism, as the allocators of capital to its most productive uses, as engines of economic growth. Regulation would only interfere with these beneficial functions. If there were occasional excesses, occasional frauds, these were unfortunate but inevitable in a free market. The solution wasn't government intervention but self-correction. Bad actors would eventually be discovered and punished by the market itself. This confidence in markets, in the fundamental soundness of the American economy, in the wisdom of letting finance operate freely, this would be tested severely in the years ahead. The crash of 1929 and the depression that followed would shatter faith in self-regulating markets, would create political pressure for fundamental reform, would transform Wall Street's relationship with government. But in the early 1920s, those disasters still lay in the future. For now, there was optimism, confidence, a sense of unlimited possibility. The physical landscape of Wall Street was changing too. New office buildings were rising in the financial district, taller and more modern than the 19th century structures they replaced. The New York Stock Exchange built a new building at the corner of Wall Street and Broad Street, with a grand neoclassical facade featuring massive columns, opened in 1903. This building, which still stands today, became the visual symbol of Wall Street, appearing in countless photographs and newsreels. Its steps became a gathering place for reporters covering financial news. Its trading floor became the most famous room in American finance. The culture of Wall Street was evolving in these years. The old line firms, the Morgan Bank, Kuhn Loeb, other established houses, maintained traditions of discretion, of serving wealthy clients, of doing business through relationships and reputation. They were often run by families, with sons succeeding fathers, maintaining continuity across generations. These firms saw themselves as institutions with public responsibilities, not just profit-seeking enterprises. They believed in maintaining standards, in preserving the reputation of the street, in exercising their power with some degree of restraint. But newer firms were emerging with different cultures. These were often more aggressive, more willing to take risks, more focused on rapid growth and spectacular profits. They pioneered new techniques, aggressive marketing to retail investors, creative financial engineering, bold speculation. They didn't have the old line firm's traditions or sense of institutional responsibility. They were entrepreneurs, opportunists, willing to push boundaries. This cultural tension between conservative, traditional banking and aggressive, innovative finance would become characteristic of Wall Street. Both approaches had strengths. The conservative approach provided stability, maintained trust, took the long view. The innovative approach generated growth, created new opportunities, adapted quickly to changing conditions. But each also had weaknesses. Conservative banking could become stodgy, could miss opportunities, could fail to serve new needs. Aggressive finance could become reckless, could prioritize short-term profits over long-term stability, could damage the system through excessive risk-taking. As we move toward the famous bull market of the mid to late 1920s, these tensions would become more pronounced. The boom years would favor the aggressive firms, would reward innovation and risk-taking, would make the conservative approach seem outdated. But when the crash came, when the consequences of excess became clear, the wisdom of conservative banking would be remembered, though by then it would be too late to prevent disaster. Let's pause here, in the early 1920s, with Wall Street positioned for its greatest boom, but not yet fully committed to the speculation that would lead to catastrophe. Picture the trading floor busier than it had ever been, with more stocks being traded, more brokers working, more money changing hands. Picture the new office buildings rising, symbols of confidence and growth. Picture the thousands of Americans across the country opening brokerage accounts for the first time, ready to participate in the great American engine of wealth creation. Picture the optimism, the sense that prosperity had become permanent, that financial innovation had solved the old problems of boom and bust. This was Wall Street at a threshold, about to enter its most spectacular and then its most catastrophic period. The foundations had been laid over more than a century, the infrastructure, the techniques, the connections, the culture. Everything was in place for the extraordinary events that would follow, but those events could wait. There's no rush. The history unfolds at its own pace. Rest if you need to. We'll continue when you're ready. The story of the 20s boom and the 29 crash will be there, patient and inevitable, waiting to be told. The great bull market of the 1920s began modestly, without fanfare or particular notice. Stock prices had recovered from the 1920 to 1921 recession and were rising steadily through 1922 and 23. But this seemed like normal recovery, nothing extraordinary. The real acceleration began in 1924 and intensified through 1925, 26, 27, reaching a crescendo in 1928 and the first 3 quarters of 1929. These years would become legendary, a period when it seemed that everyone was making money in stocks, when the market appeared to defy gravity, rising day after day, month after month, with only brief interruptions. Let's try to understand what was driving this remarkable rise, because it wasn't simply irrational exuberance or mass delusion. Though those elements were certainly present, There were real economic developments that justified some degree of optimism about American business prospects. The 1920s saw genuine technological innovation and productivity growth. Electrification was transforming industry and homes alike. The automobile was becoming a mass-market product, with Ford and General Motors producing millions of vehicles. Radio was creating a new industry and revolutionizing communications and entertainment. Airlines were beginning commercial operations. Chemical companies were developing new products. Plastics, synthetic fibers, pharmaceuticals. These innovations were creating new companies and industries, and those companies needed capital to grow. The stock market provided that capital, and investors who bought shares in successful companies made real profits as those companies grew and prospered. General Motors stock, for instance, rose from around $20 per share in 1921 to over $200 per share by 1929. Radio Corporation of America, which manufactured radios and operated broadcasting networks, rose from under $5 per share in 1921 to over $500 by 1929 before a stock split. These weren't just paper gains from speculation. They reflected actual business growth, real value creation. Corporate profits were genuinely increasing through most of the decade. Better management techniques, improved efficiency from electrification and mechanization, growing markets as the American middle class expanded, all these factors contributed to rising earnings. When companies earned more money, their stocks became more valuable. Investors who recognized these trends early and bought shares in well-managed growing companies were rewarded handsomely. This was capitalism working as it was supposed to work, capital flowing to productive enterprise, investors sharing in the prosperity they helped finance. But something else was happening alongside this genuine growth, something that would transform a healthy bull market into a dangerous bubble. As stock prices rose, as stories of ordinary people making fortunes in the market spread, investing became not just a way to build wealth, but a kind of national obsession. Newspapers devoted increasing space to financial coverage. Magazines published articles about investing strategies. Taxi drivers and shoeshine boys supposedly discussed stock tips. The market became a topic of dinner conversation, of social gatherings, of everyday life. Brokerage firms, seeing opportunity in this widespread interest, aggressively marketed their services. They opened branch offices in cities and towns across America. They advertised in newspapers and magazines, using language that emphasized the ease and profitability of investing. They offered convenient payment plans. You didn't need the full price of a stock to buy it. You could purchase on margin, putting down as little as 10% of the purchase price and borrowing the rest from your broker. This made investing accessible to people with limited savings, but it also meant that small price movements could wipe out an investor's equity or generate spectacular profits. Let's think carefully about how margin buying worked and why it was so dangerous. Suppose you wanted to buy 100 shares of a stock priced at $100 per share. That would normally cost you $10,000, but with margin buying at 10%, you would pay only $1,000 of your own money. Your broker would lend you the other $9,000, charging interest on the loan and using the stock itself as collateral. If the stock price rose to $120 per share, your 100 shares would be worth $12,000. You could sell, pay back the $9,000 loan plus interest, and pocket a profit of nearly $3,000 on your $1,000 investment. That's nearly a 300% return. This sounds magnificent, and when prices are rising, it is. But notice what happens if the price falls. If that stock drops from $100 to $90 per share, your 100 shares are now worth only $9,000, exactly what you owe your broker. Your entire $1,000 investment has been wiped out. If the price falls further, to $80 per share, your shares are worth only $8,000, but you still owe $9,000. Your broker will issue a margin call, demanding that you immediately deposit more money to cover the shortfall. If you can't come up with the money, the broker will sell your shares to recover the loan, and you'll lose not only your initial investment, but potentially owe additional money. Now imagine millions of investors, from wealthy speculators to middle-class wage earners, all buying stocks on margin, all convinced that prices will keep rising. As long as prices do rise, the system works beautifully. Everyone is making money. Brokers are earning commissions and interest on margin loans. Investors are seeing their portfolios grow. Companies are able to raise capital easily. But if prices start to fall, if even a modest decline triggers margin calls, forced selling can accelerate the decline, which triggers more margin calls, more selling, creating a downward spiral that becomes self-reinforcing. By 1928, margin debt had reached levels that should have alarmed anyone paying attention. Estimates suggest that total margin loans outstanding reached around $8.5 billion by early 1929. To put this in perspective, the entire amount of currency in circulation in the United States was around $4.5 billion. The market had become a vast pyramid of borrowed money, balanced precariously on the assumption that prices would continue rising. There were voices warning about this. The Federal Reserve, concerned about excessive speculation, began raising interest rates in 1928, trying to discourage borrowing for stock speculation. Some economists and financial commentators warned that stock prices had become detached from underlying business fundamentals, that the market was overvalued. But these warnings were drowned out by the chorus of optimism, by the evidence all around that stocks kept going up, that those who warned of danger had been consistently wrong so far. The investment trusts that proliferated in the late 20s added another layer of complexity and risk to the market. Investment trusts were corporations whose business was owning stocks in other companies. An investor could buy shares in an investment trust, thereby gaining exposure to a diversified portfolio without having to select individual stocks. This sounds like a sensible innovation. Indeed, it was the forerunner of modern mutual funds, but the investment trusts of the 20s often operated in ways that amplified risk rather than reducing it. Many investment trusts were highly leveraged, meaning they borrowed money to buy stocks, just as individual investors did. An investment trust might raise $100 million from investors, borrow another $100 million, and invest the total $200 million in stocks. If those stocks rose in value, the trust's profits were magnified, but if stocks fell, losses were similarly magnified. Some trusts invested heavily in shares of other investment trusts, creating chains of leverage. Trust A owned Trust B, which owned Trust C, which owned actual stocks. This meant that a decline in stock prices would cascade through the chain, amplifying losses at each level. The trusts were often sponsored by banks or brokerage firms that charged generous fees for management regardless of performance. They were sold to the public with aggressive marketing that emphasized past returns and glossed over risks. Many investors didn't understand what they were buying, didn't realize how leveraged the trusts were, didn't appreciate that they were paying high fees for what was often mediocre or poor stock selection. The trusts proliferated because they were profitable for their sponsors and because rising markets made even poorly managed trusts look successful. By 1929, there were hundreds of investment trusts with total assets in the billions of dollars. They had become significant players in the market, collectively owning substantial portions of many companies' shares. This meant that when the market turned, when these trusts had to sell stocks to meet redemptions or to reduce leverage, their selling would add to downward pressure on prices. The structures that had amplified gains on the way up would amplify losses on the way down. The summer of 1929 saw the market reach its ultimate peak. Prices were at levels that seemed to justify all the optimism, all the confident predictions that America had entered a new era of permanent prosperity. The Dow Jones Industrial Average, which measures the stock prices of 30 large companies, stood at 381 points in early September 1929. It had more than tripled from its 1921 low. Millions of Americans owned stocks, either directly or through investment trusts. The market seemed invincible. But there were signs of weakness for those who looked carefully. Trading volume was sometimes erratic, suggesting nervousness. Some leading stocks had stopped rising and were moving sideways or declining slightly. Economic indicators were mixed. Industrial production had actually peaked earlier in the year and was starting to soften. The agricultural sector, which had struggled through most of the 20s as crop prices remained depressed, was particularly weak. Housing construction was declining. Bank failures in agricultural areas were increasing. In late October, the market began to break. The decline started gradually, some selling, some price weakness, nothing immediately catastrophic. October the 23rd saw heavy selling, with prices falling sharply. October the 24th, which would be remembered as Black Thursday, saw panic. From the opening bell, selling pressure was intense. Prices fell precipitously. The ticker tape, the mechanical system that printed out stock prices, fell behind the actual trading, sometimes by hours, creating uncertainty and fear. If you wanted to sell a stock but didn't know what price you could get, the uncertainty could be paralyzing. By midday on Black Thursday, some of Wall Street's most powerful bankers had gathered at the offices of J.P. Morgan and Company, the same building where the elder Morgan had worked, trying to decide what to do. They agreed to pool resources and support the market, just as Morgan had done in the 1907 panic. Richard Whitney, vice president of the stock exchange and brother of a Morgan partner, walked onto the trading floor and began placing large buy orders for blue-chip stocks at prices above current market levels. The signal was clear. The banking establishment was supporting the market, and remarkably, the intervention worked, at least temporarily. Prices stabilized, then recovered somewhat. By the closing bell on Thursday, much of the day's losses had been recovered. The newspapers on Friday morning carried reassuring headlines. The bankers had demonstrated their power to steady the market. Perhaps the crisis had passed. Perhaps this was just another temporary correction, like those the market had experienced before and recovered from. The weekend brought uneasy calm. When markets reopened on Monday, October 28th, the selling resumed with renewed intensity. This time there was no banking intervention, no coordinated buying support. Prices fell sharply, with the Dow losing about 13% of its value in a single day. The losses represented the evaporation of the entire previous year's gains. Margin calls went out to investors who had bought on credit, forcing them to either deposit more money or see their holdings sold to cover loans. Tuesday, October 29th, 1929, Black Tuesday. This was the day that would live in financial infamy, the day the market truly collapsed. From the opening bell, the selling was overwhelming. Orders to sell poured in faster than they could be executed. The ticker tape fell hopelessly behind, eventually running more than 4 hours late. Investors trying to assess their positions, trying to decide whether to sell or hold, were operating blind, not knowing what prices they could actually get. 16,400,000 shares were traded that day, a record that would stand for decades. To understand how extraordinary this volume was, consider that a normal trading day might see 3 or 4 million shares change hands. The exchange's systems were overwhelmed. The clerks who recorded trades by hand couldn't keep up. The runners who carried order slips between desks were running continuously, exhausted. The noise on the trading floor was deafening. Hundreds of men shouting simultaneously, trying to execute orders, trying to find buyers for stocks that everyone wanted to sell. By the closing bell, the Dow had fallen another 12%. In just 2 days, Monday and Tuesday. The market had lost nearly a quarter of its value. Billions of dollars in wealth had vanished, or more precisely had been revealed as never having existed, as having been merely paper wealth based on inflated prices and excessive optimism. The investors who had bought at the peak were devastated. Those who had bought on margin were often completely wiped out, losing not just their investments but potentially owing money to brokers. The human stories from these days are painful to contemplate. Ordinary people who had invested their savings, who had believed the promises that stocks were the path to prosperity, who had trusted in the system, they watched helplessly as their wealth disappeared. Elderly people who had counted on stock portfolios to fund their retirement saw those plans evaporate. Families who had borrowed to invest faced not just losses, but debts they couldn't repay. The psychological impact was profound. The shock, the disbelief, the sense of betrayal. There's a famous image from this period, one that has become symbolic even though it's more myth than reality. Millionaires jumping from Wall Street skyscrapers in despair. This didn't actually happen in significant numbers. Suicide rates did increase, but not immediately after the crash, and not in the dramatic way the legend suggests. The image persists because it captures something emotionally true about the crash, the sense of sudden reversal, of people falling from great heights, of the desperate finality of financial ruin. What did happen was more prosaic, but in some ways more tragic. People lost their life savings. Small investors who had been encouraged to participate in the great bull market, who had been told that stocks were safe and profitable, lost everything. The middle-class dream of building wealth through investment turned into a nightmare of debt and loss. The faith in markets, in the financial system, in the experts who had promised that prosperity was permanent, that faith was shattered. In the days and weeks following Black Tuesday, there were attempts at reassurance. President Herbert Hoover, speaking on October 30th, declared that __5___ business leaders issued statements expressing confidence. Some prominent investors claimed they were buying stocks, that the crash represented a buying opportunity. But the reassurances rang hollow. The damage was done. Confidence once lost is not easily restored. The crash didn't end on Black Tuesday. Prices continued to fall, with occasional brief rallies that sparked hope before selling resumed. By mid-November, the Dow had fallen to about 200 points, nearly half its September peak. There would be rallies in early 1930 that would briefly lift prices, creating false hope that recovery was underway. But these rallies failed. The market would continue its terrible decline for nearly 3 more years, ultimately bottoming in the summer of 1932 at about 41 points, down nearly 90% from the 1929 peak. Let's pause and think about what the crash revealed about the market that had been built over the previous century, and especially over the previous decade. The crash exposed the dangers of leverage, of buying stocks with borrowed money. It demonstrated that markets aren't always self-correcting, that prices can become detached from fundamental values and stay detached for extended periods before reality reasserts itself. It showed that the financial innovations that looked brilliant in good times, margin buying, investment trusts, complex securities, could amplify disaster in bad times. The crash also revealed the limitations of Wall Street's self-regulation. The stock exchange had rules, the banks had standards, there were customs and practices that were supposed to maintain order. But these proved inadequate when panic struck. The bankers who tried to support the market on Black Thursday couldn't sustain that support. The systems for handling normal trading volume broke down under extreme stress. The mechanisms that were supposed to protect investors, requiring margin, limiting credit, had been relaxed in the boom years and couldn't prevent catastrophe. Perhaps most fundamentally, the crash revealed the disconnect between Wall Street and the real economy. Stock prices had risen to levels that assumed companies would earn profits far larger than was realistic. The market had priced in permanent, rapid growth that couldn't be sustained. When reality intruded, when it became clear that the economy wasn't as strong as optimists claimed, prices had to fall. But the falling prices then damaged the real economy. As wealth evaporated, people spent less, businesses cut back, unemployment rose, creating a downward spiral that would become the Great Depression. In the immediate aftermath of the crash, many people believed, or wanted to believe, that this was just a market event, a financial phenomenon that wouldn't significantly affect the broader economy. Stocks had gone too high, now they had corrected, but this didn't necessarily mean depression or economic collapse. The fundamentals were still sound. Industry could continue operating. Workers would keep their jobs. Life would go on. This hope would prove tragically wrong. The crash wasn't just a financial event. It was the beginning of the worst economic catastrophe in American history. A depression that would last a decade, that would put 1/4 of the workforce out of work, that would devastate industries and farms, that would create suffering on a scale hardly imaginable. The crash and the depression were connected, though exactly how remains debated by economists. Did the crash cause the depression, or did they both result from the same underlying weaknesses in the economy? The answer probably involves both. The crash both reflected and worsened economic problems that were already present. What's certain is that the crash marked a turning point. The optimism of the 20s, the faith in unfettered markets, the belief that prosperity had become permanent, all this died in October 1929. The world that would emerge from the Depression would be different, would involve much more government oversight of finance, much more skepticism about market wisdom, much more focus on stability rather than speculation. But in late 1929, that future wasn't yet visible. People were still trying to understand what had happened, still hoping recovery would come quickly, still not fully grasping that their world had fundamentally changed. Picture Wall Street in the weeks after the crash. The trading floor, which had been so chaotic during the worst days, now quieter, subdued. The ticker tape, which had run hours behind during peak selling, now keeping up easily because trading volume had fallen off. The brokerage offices, which had been packed with customers watching prices rise month after month, now emptier, the crowds gone. The newspapers, which had devoted front pages to market coverage during the boom, now reporting the grim statistics of decline with a kind of shell-shocked bewilderment. The great bull market had ended. The crash had happened. The consequences were still unfolding, still not fully understood, but already it was clear that something enormous had occurred, that an era had ended, that the easy confidence of the 20s was finished. Let that image settle. The quiet trading floor, the depleted brokerage offices, the stunned recognition that the party was over. We'll continue the story, following Wall Street through the Depression years and beyond. But there's no rush. The history can wait. Rest if you need to. The past is patient with us. The years following the 1929 crash brought a transformation of Wall Street and American finance that was as profound as anything in the nation's history. The Depression wasn't just an economic disaster. It was a political and ideological earthquake that shattered faith in the financial system and created demands for fundamental reform. Wall Street, which had operated with minimal government oversight for nearly a century and a half, would find itself subjected to regulations that changed its basic operations, its relationship with the public, its very culture. The early years of the Depression saw Wall Street struggling not just with economic collapse, but with a crisis of legitimacy. As unemployment rose, as banks failed, as ordinary Americans lost their savings and their homes, anger turned toward the financial system and the men who ran it. Wall Street became a symbol of the greed and recklessness that many believed had caused the disaster. The financiers who had been celebrated as masters of the universe during the boom years were now vilified as villains who had enriched themselves while leading the country to ruin. The Senate Banking Committee, led by Ferdinand Pecora, conducted hearings in 1933 and 34 that exposed practices on Wall Street that shocked the American public. The Pecora hearings, as they became known, revealed a world of insider dealing, market manipulation, tax evasion, conflicts of interest, and practices that seemed designed to benefit financiers at the expense of ordinary investors. Prominent bankers were called to testify, cross-examined in public, forced to explain transactions that looked corrupt or at minimum unethical. Charles Mitchell, head of National City Bank, one of the country's largest banks, was questioned about selling bank stock to the public at inflated prices, while bank insiders were selling their own shares. He admitted to avoiding income taxes through transactions that had no purpose except tax evasion. His testimony was damaging not just to himself, but to the reputation of banking generally. Here was one of the most respected bankers in America admitting under oath to practices that seemed to violate the basic trust that banking required. The revelations kept coming. The hearings exposed stock pools, coordinated schemes where groups of traders would manipulate stock prices, driving them up through coordinated buying and false rumours, then selling at the peak to unsuspecting public investors who believed the price rise reflected genuine value. These pools had operated openly during the 20s, considered clever business rather than fraud. Now exposed in the harsh light of Depression-era scrutiny. They looked like theft. The hearings revealed that investment banks had sold bonds to the public while privately expressing doubts about whether the bonds would be repaid. They showed how banks created affiliated securities companies to circumvent regulations, how they traded on inside information, how they engaged in self-dealing that benefited bank officers at shareholder expense. The cumulative picture was of a system that was rigged, that operated for the benefit of insiders, that treated ordinary investors as marks to be exploited rather than clients to be served. J.P. Morgan Jr., son of the great J.P. Morgan and head of the Morgan Bank, testified in 1933. The questioning revealed that Morgan and many of his partners had paid no income taxes in 1931 and 1932. Despite substantial incomes, this was legal. They had taken losses that offset their gains, but it looked terrible. Here were some of the richest men in America paying no taxes while ordinary workers were struggling to survive. The political impact was enormous, fueling demands for both tax reform and financial regulation. The hearings also exposed what was called a quote six, a practice where Morgan partners would offer shares in promising new securities issues to influential people, politicians, corporate executives, prominent citizens at below-market prices. These favoured individuals could immediately sell the shares at a profit. It was a form of legal bribery, creating obligation and goodwill. The Morgan Bank defended it as normal business practice, but to the public it looked like corruption, like Wall Street buying influence with gifts disguised as investment opportunities. Ferdinand Pecora, the chief counsel running the hearings, became a folk hero. He was the son of Italian immigrants, a former assistant district attorney from New York, not part of the Wall Street establishment. His aggressive questioning, his ability to understand complex financial transactions and expose their problematic aspects in plain language, his evident conviction that Wall Street had betrayed the public trust, all this resonated with Depression-era Americans who felt victimized by the financial system. The hearings he conducted created the political climate that made comprehensive financial reform possible. The response to these revelations was the New Deal financial legislation of 1933 and 1934. The Glass-Steagall Act, passed in June 1933, fundamentally restructured American banking. Its most famous provisions separated commercial banking from investment banking. Banks that took deposits from the public could no longer engage in securities, underwriting, and dealing. They had to choose, be a commercial bank or an investment bank, but not both. The theory was that mixing these functions created conflicts of interest and encouraged banks to take excessive risks with depositors' money. Glass-Steagall also created federal deposit insurance through the Federal Deposit Insurance Corporation. This was revolutionary. For the first time, the government guaranteed bank deposits up to a certain amount, initially $2,500, later raised. This meant that ordinary depositors no longer had to fear losing their savings if their bank failed. The insurance was funded by premiums paid by banks, but it was backed by the full faith and credit of the federal government. The impact on banking stability was immediate and dramatic. Bank runs, which had been endemic through the early Depression, essentially stopped. When people knew their deposits were safe, they had no reason to panic and withdraw their money at the first sign of trouble. The Securities Act of 1933 required companies offering securities for sale to the public to register those securities with the government and to provide detailed information about their finances, their business, their risks. This was the first federal securities regulation in American history. Previously, securities offerings had been regulated only by state laws that varied widely and were often weak. Now there would be federal standards, federal disclosure requirements, federal penalties for fraud or misrepresentation. The Securities Exchange Act of 1934 went further. It created the Securities and Exchange Commission to regulate securities markets and enforce securities laws. The SEC was given broad powers to register securities exchanges, to regulate trading practices, to investigate fraud, to enforce disclosure requirements. It could require periodic reports from publicly traded companies. It could regulate insider trading. Though the laws and rules around this would develop over time, it could oversee the practices of brokers and dealers. President Franklin Roosevelt appointed Joseph Kennedy, father of the future President John F. Kennedy, as the SEC's first chairman. This was a controversial choice. Kennedy had made a fortune in various businesses, including stock speculation, and there were rumors that some of his trading had involved the kind of manipulation the SEC was supposed to prevent. But Roosevelt believed that Kennedy's knowledge of Wall Street's tricks would help him police them. __, quote _7, Roosevelt reportedly said. Though not publicly, Kennedy served as SEC chairman for 15 months and was generally regarded as effective, establishing the Commission's credibility and beginning the work of creating a regulatory framework for securities markets. The New Deal legislation didn't just create new rules, it embodied a new philosophy about the relationship between finance and government. The 19th century view had been that markets should be self-regulating, that government intervention would be counterproductive, that investors needed to look out for themselves. The New Deal rejected this view. Markets, left to themselves, had produced disaster. They needed oversight. Investors, particularly small investors, needed protection from fraud and manipulation. The government had a responsibility to ensure that financial markets operated fairly and transparently. Wall Street resisted these changes, though the resistance was complicated by the fact that Wall Street itself was devastated and demoralized. The securities industry was in shambles. Trading volume had collapsed. The billion-share trading years of the late 20s had given way to years when total annual volume was measured in hundreds of millions of shares. Brokerage firms were failing. Investment banks were struggling. Wall Street couldn't mount effective political resistance because it was fighting for survival. But many on Wall Street believed the New Deal regulations went too far, that they would strangle finance, that they reflected ignorance about how markets actually worked. The requirement to disclose detailed financial information would give away competitive secrets, they argued. The separation of commercial and investment banking would reduce efficiency. Federal regulation would be bureaucratic and inflexible. These arguments had some validity. Regulation does impose costs, does reduce flexibility, can have unintended consequences. But in the political climate of the mid-1930s, after the Pecora hearings had exposed so much corruption and excess, these arguments couldn't overcome the demand for reform. The reforms did change Wall Street fundamentally. Investment banking firms, the Morgan Bank, Kuhn Loeb, Goldman Sachs and others, had to spin off their commercial banking operations or close them entirely. J.P. Morgan and Company chose to remain a commercial bank, while its partners formed a separate investment banking firm that eventually became Morgan Stanley. National City Bank spun off its securities affiliate. The industry that emerged was structurally different, with clearer separation between different types of financial activity. The requirement to disclose financial information changed how companies and investors interacted. Before the Securities Acts, companies could keep their finances largely secret. They might publish some information to attract investors, but there was no standard format, no independent verification, no requirement to disclose uncomfortable facts. After the Acts, publicly traded companies had to file regular, detailed reports. They had to have their financial statements audited by independent accountants. They had to disclose material information that might affect investment decisions. This transparency had multiple effects. It made it harder for companies to hide problems, harder for insiders to profit from information the public didn't have, harder for promoters to sell worthless securities through deception. But it also imposed costs on companies. The cost of preparing detailed reports, of paying auditors, of making public information that competitors could use. And it created new industries, accounting firms that could conduct the required audits, law firms that specialized in securities law, financial analysts who could interpret the newly available information. The regulation of trading practices made some forms of market manipulation illegal. Stock pools, which had been common in the 20s, became criminal fraud. Spreading false rumors to move stock prices became illegal. Insider trading, using material non-public information to trade securities, was regulated, though the law and enforcement in this area would develop gradually over decades. These rules didn't eliminate manipulation and fraud. Determined wrongdoers could still find ways around them, but they made such activities riskier and less blatant. Through all of this regulatory transformation, Wall Street was also dealing with the ongoing economic disaster of the Depression. Stock prices, which had fallen catastrophically in 1929 through 32, recovered somewhat in 1933 and 34, but remained far below their 1929 peaks. Trading volume stayed depressed. Many of the investment trusts that had proliferated in the 20s had collapsed entirely, their shares becoming worthless. Brokerage firms that had employed thousands in the boom years now had skeleton staffs. The culture of Wall Street changed in these years. The aggressive, optimistic, risk-taking culture of the 20s gave way to something more cautious, more conservative, more aware of limits. The men who had lost fortunes in the crash, who had seen their firms fail or struggle, who had been hauled before congressional committees and publicly humiliated, they learned lessons about hubris and risk. A new generation entering Wall Street in the 30s did so in a chastened industry that emphasized prudence rather than speculation. But Wall Street also demonstrated resilience. The industry survived the depression, survived the regulations, survived the loss of public trust. It adapted to the new regulatory environment, learning to work within the rules even as many continued to argue the rules were too restrictive. Firms that survived the depression years were often strengthened by the experience. They had proven they could endure the worst, had built reputations for reliability and soundness. The Second World War, which America entered in December 1941, brought another transformation. The war required financing on a scale that dwarfed even the First World War. The federal government sold war bonds to the public in massive campaigns, raising hundreds of billions of dollars. Wall Street firms participated in these bond drives, underwriting and distributing the securities. This was patriotic service, but it also kept the machinery of finance operating, kept relationships active, prepared the industry for the post-war boom that would come. The war also brought production controls, price controls, rationing, a level of government intervention in the economy that would have been unthinkable in peacetime. Wall Street operated in this controlled environment, facilitating the financial transactions that supported war production. Stock trading continued, though at low volumes and with many restrictions. The market became almost a sideshow to the real drama of the war. Prices were relatively stable, moving in a narrow range, reflecting both the controlled economy and the fact that investors' attention was elsewhere. By the time the war ended in 1945, Wall Street had been operating under New Deal regulations for more than a decade. What had seemed radical in the mid-30s had become normal, accepted, part of how business was done. The separation of commercial and investment banking was now the structure of the industry. Disclosure requirements were routine. SEC oversight was a fact of life. The financial system that emerged from the war was fundamentally different from the system that had existed before the Depression. More regulated, more transparent, more stable, but also arguably less innovative, less dynamic, more constrained. The question was what would happen in peacetime when the economy returned to normal operation, when the pent-up demand from years of depression and war could finally be satisfied. Would Wall Street boom again, or had the regulations and the cultural changes from the Depression permanently limited its role? Would the public trust Wall Street again, invest in stocks again, or had the betrayal of the 20s and the suffering of the 30s created permanent skepticism? These questions would be answered in the post-war decades, in the long boom that would transform America into a middle-class society of unprecedented prosperity. But in 1945, as the war ended and soldiers came home, as the economy began its transition to peacetime, the answers weren't yet clear. Wall Street stood at another threshold, shaped by regulation and chastened by disaster, but still the center of American finance, still essential to the functioning of capitalism, still capable of both service and excess. Picture Wall Street in 1945. The physical street largely unchanged, the same buildings, the same stock exchange, the same narrow canyon between tall structures. But the industry that operated there had been transformed. The wild speculation of the 20s was gone, replaced by more sober practice. The unregulated markets of the 19th century were gone, replaced by federal oversight. The public's naive faith in Wall Street wisdom was gone, replaced by skepticism and caution. But the fundamental function remained. Capital still needed to be raised. Companies still needed to sell securities to finance growth. Investors still needed markets where they could buy and sell. Wall Street still provided these services, now operating within a framework of rules designed to prevent the worst excesses, to protect investors, to maintain stability. Whether this new arrangement would prove successful, whether the regulations would prevent another catastrophic crash while still allowing markets to function efficiently, that remained to be seen. The test would come in the decades ahead. Let that image rest for now. Wall Street at mid-century, transformed but enduring, regulated but still operating, chastened but not destroyed. The story continues forward from here, through the post-war boom, through new challenges and changes, through the long evolution toward the Wall Street we know today. But we'll come to that. For now, rest if you need to. The history will wait, patient and inevitable, ready to unfold when you're ready to hear it. The decades following the Second World War saw Wall Street enter what might be called its golden age of regulated capitalism, a period when the New Deal framework provided stability, while the booming post-war economy created opportunities for growth that benefited both Wall Street and the broader public. These were years when the financial system seemed to work as it was supposed to work, channeling capital to productive uses, creating wealth that was more widely shared than in previous eras, operating within rules that prevented the worst excesses while still allowing innovation and profit. The immediate post-war years saw concerns that America might slip back into depression once wartime production ended. Millions of servicemen were returning home, needing jobs. Factories that had produced weapons and military equipment needed to convert to civilian production. Government spending, which had driven the wartime economy, was being reduced dramatically. The conditions seemed ripe for recession, or worse. But the feared post-war depression never materialized. Instead, the economy boomed. There were several reasons for this remarkable post-war prosperity. American industrial capacity had expanded enormously during the war and emerged from the conflict intact, while European and Japanese industry had been devastated by bombing. This gave American manufacturers a competitive advantage in global markets. Consumers had accumulated savings during the war years when goods were rationed and spending opportunities limited. Now they were ready to spend. The GI Bill provided veterans with education benefits and home loans, creating a massive expansion of the educated middle class and suburban home ownership. Government spending, though reduced from wartime peaks, remained much higher than in the pre-war era, providing continued stimulus. Wall Street participated in and facilitated this boom. Companies expanding to meet post-war demand needed capital, and they raised that capital by selling stocks and bonds. The securities markets, which had been moribund during the Depression and restricted during the war, began to revive. Trading volume increased. Stock prices, which had remained depressed for more than a decade, began to rise. Not explosively, not with the manic speculation of the 20s, but steadily, reflecting genuine economic growth and corporate profitability. The post-war stock market was different from its predecessors in important ways. The New Deal regulations meant companies had to disclose more information, making it easier for investors to make informed decisions. The SEC actively policed fraud and manipulation, making markets cleaner. Margin requirements, the minimum percentage of a stock's price that had to be paid in cash rather than borrowed, was set by the Federal Reserve and kept relatively high, preventing the kind of excessive leverage that had characterized the 20s. These regulations hadn't eliminated risk or guaranteed profits, but they had created a more level playing field, a market where ordinary investors had a better chance. Stock ownership began to spread more widely through the American population during these decades. This wasn't the mass speculation of the 20s, when taxi drivers were supposedly trading stocks. It was more methodical, more long-term oriented. Companies began offering pension plans that invested in stocks. Mutual funds, the legitimate descendants of the 20s investment trusts, but now regulated and required to operate transparently, grew in popularity, allowing middle-class investors to own diversified portfolios. The idea that stock ownership should be part of building long-term wealth, a part of saving for retirement, became more widely accepted. The New York Stock Exchange actively promoted this broader participation. In the 1950s, the exchange ran advertising campaigns encouraging Americans to invest, to own shares in American companies, to participate in capitalism. __quote_8 _ was one slogan. This was partly self-interest. More investors meant more trading, more commissions for brokers, but it also reflected a genuine belief that widespread stock ownership was good for democracy, that it gave more people a stake in the capitalist system, that it could help create a society of small investors rather than a plutocracy of the wealthy few. By the early 1960s, approximately 17 million Americans owned stocks, either directly or through mutual funds. This was a substantial increase from the pre-war era. Though still a minority of the population, stock ownership remained concentrated among the middle and upper classes. Working-class families were more likely to keep savings in banks or government bonds. But the trend was toward wider participation, toward the democratization of investment that reformers had long advocated. The types of companies whose stocks traded on Wall Street were evolving too. The 1950s and 60s saw the rise of what President Eisenhower called the military-industrial complex: aerospace companies, defense contractors, electronics manufacturers whose business was heavily dependent on government defense spending. Companies like Boeing, Lockheed, General Dynamics became major corporations, and their stocks became important parts of portfolios. This created a strange situation where investors were profiting from the Cold War arms race, where weapons production was a source of corporate profits and stock appreciation. Technology companies began to emerge as significant players. International Business Machines, IBM, became one of the most valuable companies in America, dominating the computer industry. Other technology firms, Texas Instruments, Hewlett-Packard, Xerox represented the new economy, the transition from industrial manufacturing to information technology. Investors who recognized these trends early, who understood that computers and electronics would be transformative, could profit enormously. IBM stock, for instance, appreciated hundreds of times over from the late 1940s through the 1970s, creating many individual fortunes. The investment banking business was changing as well. The Glass-Steagall separation between commercial and investment banking remained in effect, creating distinct industries with different cultures and business models. Investment banks, firms like Morgan Stanley, First Boston, Kuhn Loeb, Goldman Sachs, focused on underwriting securities, advising companies on mergers and acquisitions, trading securities. They were partnerships, owned by their senior partners rather than by public shareholders. This partnership structure meant that the people making decisions had their own money at risk, which theoretically encouraged prudence. The investment banks of the post-war era operated within established practices and social norms. They were gentlemanly businesses, at least in their self-conception. Relationships mattered more than raw profit maximization. A firm maintained relationships with particular corporate clients across decades, serving as their trusted advisor for financing and strategic decisions. Competition existed, but it was restrained, governed by informal rules about what was acceptable. Poaching another firm's clients was frowned upon. Undercutting fees was considered ungentlemanly. The industry operated as something of a club, with understood boundaries and shared standards. This culture had both positive and negative aspects. On the positive side, the focus on relationships and reputation encouraged firms to take the long view, to prioritize client service over short-term profit, to maintain high standards of integrity because damage to reputation would be costly. Investment bankers saw themselves as advisors and counselors, not just deal makers. They took pride in their work, in solving complex financial problems, in helping build American business. On the negative side, the club-like nature of Wall Street meant exclusivity and discrimination. The major investment banks were dominated by white Protestant men, often from elite backgrounds. Jews faced discrimination in many firms, though Jewish-founded firms like Goldman Sachs and Lehman Brothers succeeded by serving clients others wouldn't. Women were largely absent except in secretarial roles. African Americans were almost completely excluded. The meritocracy that Wall Street claimed to be was deeply compromised by bias and exclusion. The merger and acquisition business grew substantially during the 1950s and 60s. Companies were combining, consolidating, seeking to grow through acquisition rather than just internal expansion. Investment banks advised on these transactions, helping to value companies, structure deals, arrange financing. This M&A advisory work became increasingly important and profitable. It required different skills than traditional underwriting: financial analysis, negotiation, strategic thinking. The firms that built expertise in M&A, that developed reputations for handling complex deals, prospered. Some of these mergers created genuine value through achieving economies of scale or combining complementary businesses. Others were driven more by executives' empire-building ambitions than by sound business logic. Wall Street generally didn't distinguish much between these categories. A deal was a deal, and if a client wanted to pursue an acquisition, the investment bank would help structure and finance it, collecting fees regardless of whether the merger ultimately succeeded or failed. The 1960s saw the emergence of what were called conglomerates, companies that grew by acquiring businesses in unrelated industries. The theory was that professional managers could run any business, that diversification across industries would smooth earnings, that financial engineering could create value even without operational synergies. Companies like ITT, Gulf and Western and Litton Industries built vast empires of disparate businesses. Wall Street facilitated these conglomerates, underwriting the securities that financed acquisitions, earning substantial fees. The conglomerate boom eventually collapsed in the early 1970s as it became clear that managing diverse, unrelated businesses was harder than the theory suggested, that the supposed benefits of diversification didn't materialize, that in many cases the whole was worth less than the sum of the parts. But while it lasted, the conglomerate movement generated substantial investment banking fees and kept dealmakers busy. It demonstrated a recurring pattern in finance. Trends and theories that seem brilliant in the moment often prove problematic with the benefit of hindsight. The late 1960s and early 70s brought new challenges. Inflation began to rise, driven partly by government spending on both the Vietnam War and President Johnson's Great Society programs, without corresponding tax increases. The Federal Reserve, caught between the desire to support economic growth and the need to control inflation, struggled to find the right policy balance. Stock prices, which had risen fairly steadily through the 50s and early 60s, became more volatile. The Dow Jones Industrial Average, which had broken through 1,000 in 1972, would spend the rest of the decade bouncing around that level without sustained growth. The 1973 to 74 stock market decline was severe, though not as catastrophic as 1929. The Dow fell from over 1,000 to below 600, a decline of more than 40%. This was the worst market downturn since the Depression, and it shook investor confidence. The decline was driven by multiple factors: the oil price shock when Arab oil producers embargoed exports to the United States, high inflation, rising interest rates, the Watergate scandal and Nixon's resignation, general economic uncertainty. The combination created what became known as stagflation, simultaneous high inflation and economic stagnation, a condition that conventional economic theory suggested shouldn't happen. Wall Street firms struggled during these years. Trading volumes fell as investors retreated from stocks. Underwriting business slowed as companies pulled back on expansion plans. Some major firms failed or had to be rescued. The industry that had seemed so prosperous in the 50s and 60s was facing its most difficult period since the Depression. Yet the regulatory framework held. There were no bank runs, no financial system collapse, no repeat of Depression-era catastrophe. The New Deal reforms, whatever their limitations, had created enough stability to prevent crisis from becoming catastrophe. The fixed commission structure that had governed stock trading since the stock exchange's founding came under pressure during the 1970s. For nearly 2 centuries, brokers had charged set commissions based on the dollar value of trades, a percentage that was the same regardless of which broker you used, regardless of how large your trade was, regardless of any consideration except the transaction amount. This system guaranteed profits for brokers, but meant investors couldn't shop for lower prices. The SEC, responding to pressure from institutional investors who made large trades and resented paying high fixed commissions, pushed for competitive commissions. The stock exchange resisted, arguing that fixed commissions were necessary to maintain the quality of service, to support research and other services brokers provided, but the SEC prevailed. On May 1st, 1975, a date known in the industry as May Day, fixed commissions were abolished. Brokers could now compete on price. The immediate effect was a substantial reduction in commission rates, particularly for large institutional trades. But the longer-term effects were more profound. The brokerage industry began to restructure. Firms that competed primarily on price, discount brokers, emerged to serve price-sensitive customers. Full-service brokers had to justify their higher fees by providing research, advice, and other value-added services. The industry became more competitive, more differentiated, more focused on efficiency. The late 1970s saw the beginning of technologies that would eventually transform trading. Computers had been used for back-office functions, record-keeping, settlement, since the 1960s. But now they began to be used for trading itself. The Nasdaq stock market, founded in 1971, was the first electronic stock market. Operating without a physical trading floor, trades were executed through computers and telephone networks rather than face-to-face on an exchange floor. This was revolutionary, though at first Nasdaq listed primarily smaller companies that didn't meet the NYSE's listing requirements. The technological changes were gradual at first. The New York Stock Exchange maintained its traditional floor trading, with brokers executing trades in person. But technology was enabling new possibilities: faster execution, lower costs, trading strategies that would have been impossible without computers. The seeds of the future electronic marketplace were being planted, though they wouldn't fully bloom for decades. Through all these changes, one constant remained: Wall Street's centrality to American capitalism. Despite the regulations, despite the challenges, despite the periodic market downturns, Wall Street remained the place where capital was raised, where companies went public, where investors bought and sold securities. The system had proven resilient, had adapted to regulation, had survived the worst that the Depression and post-war challenges could throw at it. The post-war decades had demonstrated that regulated markets could work, that rules requiring disclosure and prohibiting manipulation didn't prevent markets from functioning, that stability and growth could coexist. This wasn't the laissez-faire Wall Street of the 19th century or the speculative frenzy of the 1920s. It was something more measured, more stable, perhaps less exciting but also less dangerous. Whether this balance could be maintained, whether the lessons of the Depression would continue to guide policy, would be tested in the decades ahead. As we pause here, in the late 1970s, Wall Street stood at another transition point. Behind it lay 3.5 decades of regulated markets, steady growth, relative stability. Ahead lay the deregulatory movement of the 80s, the explosive growth of financial innovation, globalization, technology-driven transformation. The world that would emerge would be in many ways more dynamic, more global, more complex than what had come before. But it would also raise questions about whether the balance struck in the post-war era between freedom and regulation, between innovation and stability, was being lost. Picture Wall Street in the late 70s. The physical street still there, still the symbolic center of American finance, the stock exchange still operating in its neoclassical building, the investment bank still headquartered in the financial district. But the world around Wall Street was changing. Computers in offices, electronic tickers replacing mechanical ones. The first signs of the technological revolution that would transform everything. A world poised between the regulated stability of the post-war era and the deregulated dynamism of the coming decades. Let that image settle. We'll continue forward, but there's no hurry. The past is patient with us, and the future can wait. The 1980s brought a transformation of Wall Street that was as dramatic in its way as the regulatory revolution of the 1930s had been. But moving in the opposite direction, where the 30s had been about imposing rules and constraints, the 80s were about removing them. Where the New Deal era had emphasized stability and investor protection, the Reagan era emphasized freedom and market efficiency. This shift wasn't simply about policy. It reflected changing ideas about how economies should work, what government's role should be, what capitalism itself meant. Ronald Reagan's election in 1980 brought to power an administration ideologically committed to reducing government regulation of business. The theory, influenced by economists like Milton Friedman, was that markets worked best when left free, that regulation created inefficiency and stifled innovation, that the private sector was better at allocating resources than government could ever be. This wasn't entirely new thinking. Similar ideas had been dominant before the Depression, but it represented a sharp break from the post-war consensus that had accepted substantial government oversight of the economy. For Wall Street, deregulation meant opportunity. Restrictions that had constrained business for decades were being reconsidered and eliminated. New financial products could be created without lengthy regulatory approval. Companies could raise capital in novel ways. The boundaries between different types of financial institutions, which had been clearly defined since Glass-Steagall, began to blur as regulators allowed banks and securities firms to enter each other's businesses. The careful balance struck in the post-war era between freedom and oversight was shifting decisively toward freedom. One of the most significant developments of the 80s was the explosion of mergers and acquisitions activity. The M&A business, which had been significant in the 60s and 70s, became enormous in the 80s. Companies were buying other companies in transactions worth hundreds of millions or billions of dollars. Some were friendly mergers negotiated between management teams who believed combination made strategic sense. But many were hostile takeovers, one company buying another over the objections of the target company's management, using techniques that were aggressive and often brutal. The hostile takeover typically worked like this. A corporate raider, someone seeking to take control of a company, would identify a target company whose stock price seemed low relative to the value of its assets or its potential earnings. The raider would begin accumulating shares, sometimes secretly to avoid driving up the price. Once enough shares were controlled or a takeover was announced, the raider would make a tender offer, an offer to buy shares directly from stockholders at a price above the current market price, bypassing the company's management. Target company managements fought back with various defensive tactics. They might implement poison pills, provisions that would make the company less attractive or more expensive if taken over. They might seek white knights, friendly buyers who would acquire the company instead of the hostile raider. They might try to buy back their own stock to prevent the raider from accumulating a controlling stake. The battle between raiders and targets created huge fees for investment banks, which advised both sides and for lawyers who fought the legal battles. Some takeovers were genuinely motivated by a belief that the raider could run the acquired company better than existing management, that assets were being poorly utilized, that changes in strategy or management could unlock value. The theory was that the threat of takeover disciplined managers, forced them to maximize shareholder value, prevented complacency. If you ran your company poorly, if your stock price lagged, you became a takeover target. This was market discipline in action. But many takeovers were motivated by financial engineering rather than operating improvements. Leverage buyouts, LBOs, became common. In an LBO, investors would buy a company using mostly borrowed money, perhaps putting up only 10 or 20% of the purchase price in equity and borrowing the rest. The acquired company's assets would serve as collateral for the loans. After the acquisition, the company would be run to generate cash to pay down the debt, often by cutting costs, selling assets, or refinancing. If all went well, the LBO investors would end up owning a valuable company while having invested relatively little of their own money. The junk bond market, developed primarily by Michael Milken at the investment bank Drexel Burnham Lambert, provided the financing that made many of these LBOs possible. Junk bonds were corporate bonds rated below investment grade, bonds issued by companies considered at significant risk of default. Because they were risky, junk bonds paid high interest rates, sometimes 12 or 15% or even higher. Before Milken, there had been a small market in fallen angels, bonds that had been investment grade when issued, but had been downgraded after the issuing company got into trouble. But Milken created a market for original issue junk bonds, convincing investors that the high yields justified the risks. Milken's insight was that a diversified portfolio of junk bonds would perform better than investors expected. Some companies would default, yes, but many would succeed, and the high interest rates on the successful bonds would more than compensate for losses on the defaulted ones. He assembled a client base of savings and loans, insurance companies, mutual funds that were willing to buy junk bonds. Then he used this ready market to finance corporate takeovers, raising billions of dollars for raiders who wanted to buy companies but lacked the capital to do so with conventional financing. The amounts of money involved became staggering. The largest LBO of the 80s was the buyout of RJR Nabisco in 1988 for approximately $25 billion. The battle for RJR Nabisco, chronicled in the book Barbarians at the Gate, epitomized both the drama and the excesses of 80s deal-making. Multiple bidders competed, driving the price higher and higher. Investment bankers and lawyers worked around the clock for weeks. The final purchase price was so high that it would prove difficult to service the debt, but in the frenzy of the bidding war, that concern was pushed aside. Wall Street investment banks made enormous fees from this M&A activity. On a billion-dollar transaction, a bank might earn 1% or more in advisory fees, $10 million or more for a few months of work. The most aggressive deal-makers became extraordinarily wealthy. The partnership structure that had characterized investment banking for decades began to break down. Some firms went public, selling shares to outside investors, which gave partners a way to cash out their stakes, but also changed incentives. Public shareholders wanted growth and profits, not the conservative, relationship-focused approach that partnerships had encouraged. The culture of Wall Street was changing too. The gentlemanly, relationship-based culture of the post-war era gave way to something more aggressive and transactional. Young investment bankers worked 100-hour weeks, driven by the promise of enormous year-end bonuses if they brought in deals. The phrase "greed is good" from the 1987 film Wall Street became iconic, capturing something real about the era's values even as it was meant as satire. Making money, accumulating wealth, winning deals, these became the primary measures of success, displacing older values about client service or building institutions meant to last. Technology was accelerating the pace of change on Wall Street. Personal computers arrived in offices in the early 80s. Initially for word processing and spreadsheets, but increasingly for financial analysis and modeling. Being able to quickly model different financial scenarios, to calculate the impact of various deal structures, to analyze reams of data, this changed how investment banking worked. Junior bankers would spend nights creating detailed financial models, printed on continuous feed paper from dot matrix printers, analyzing every possible variation of a transaction. Trading became increasingly computerized. Program trading, using computers to execute large orders automatically based on predetermined criteria, emerged in the mid-80s. Index arbitrage, taking advantage of small price discrepancies between stock index futures and the underlying stocks, became possible through computer-driven trading. These techniques could move markets, executing thousands of shares in seconds, creating volatility that human-only trading had never produced. The rapid pace of technological change and the increasing complexity of financial instruments created a gap between Wall Street insiders who understood what was happening and ordinary investors who didn't. Derivatives, financial instruments whose value derived from underlying assets, proliferated. Options, futures, swaps, increasingly exotic combinations. These instruments could be useful for hedging risk or for speculation, but they were complex, difficult to value, hard for regulators to oversee. The financial system was becoming more sophisticated but also more opaque. October 19, 1987, brought a sharp reminder that markets could still crash despite all the advances in technology and financial engineering. On that single day, the Dow Jones Industrial Average fell more than 22%, a larger percentage decline than any single day in 1929. The crash was sudden and shocking. The day began with heavy selling that accelerated throughout the day. Program trading and portfolio insurance, strategies that automatically sold when prices fell, amplified the decline. By the closing bell, more than $500 billion in market value had evaporated. The 1987 crash was different from 1929 in crucial ways. It didn't lead to a depression or even a serious recession. The Federal Reserve, led by Chairman Alan Greenspan, who had been in the job only 2 months, immediately announced it would provide liquidity to support the financial system. Banks kept lending. The stock market recovered relatively quickly. Within 2 years, prices had returned to pre-crash levels. The regulatory structure created in the 30s, strengthened by experience, prevented the crash from spreading through the financial system the way 1929 had. But the 87 crash did raise questions about whether technology and program trading had made markets more volatile, more prone to sudden disruptions. The SEC and other regulators implemented circuit breakers, automatic halts in trading if prices fell too quickly, to prevent cascading declines driven by computer algorithms. These were adaptations, attempts to regulate new technologies without fully understanding them, trying to prevent disaster while allowing innovation to continue. The savings and loan crisis of the late 80s and early 90s demonstrated the dangers of deregulation without adequate oversight. Savings and loan institutions, S&Ls, were specialized banks that took deposits and made home mortgages. They had been heavily regulated, limited in what they could invest in, restricted in the interest rates they could pay. In the early 80s, these regulations were loosened. S&Ls could now invest in commercial real estate, in junk bonds, in riskier assets. They could pay higher interest rates to attract deposits. The theory was that deregulation would make them more competitive and profitable. Instead, deregulation created opportunities for fraud and mismanagement. Some S&L executives made risky investments with depositors' money. Seeking high returns to justify the high interest rates they were paying, others engaged in outright fraud, using S&Ls as personal piggy banks. When the investments went bad, when real estate values fell, when junk bonds defaulted, S&Ls failed by the hundreds. Because deposits were federally insured, taxpayers ended up covering the losses. The final cost of the S&L crisis to taxpayers was approximately $130 billion. The S&L crisis implicated Wall Street because investment banks had sold many of the junk bonds and risky securities that S&Ls had invested in. The relationship between Drexel Burnham Lambert and various S&Ls was particularly problematic. Drexel had cultivated S&Ls as buyers for junk bonds, sometimes without fully disclosing the risks, sometimes with arrangements that looked like kickbacks or bribes. When it all unravelled, when the junk bond market collapsed and Drexel's main clients were failing S&Ls, the firm couldn't survive. Drexel filed for bankruptcy in 1990, a stunning fall for what had been one of the most profitable firms on Wall Street. Michael Milken, Drexel's junk bond king, was prosecuted for securities fraud and racketeering. He pleaded guilty to 6 felonies in 1990 and was sentenced to 10 years in prison, though he served less than 2. The charges involved technical violations, parking securities to hide ownership, helping clients evade taxes, rather than the fundamental innovation of the junk bond market. But Milken's prosecution and imprisonment symbolized the excesses of the 80s, the sense that Wall Street had gone too far, that what had been celebrated as financial innovation had often been fraud or manipulation dressed up in sophisticated language. The late 80s and early 90s brought insider trading scandals that shocked the public and embarrassed Wall Street. Even Boesky, an arbitrageur who traded on takeover rumours, admitted to insider trading and paid $100 million in fines. His cooperation with prosecutors helped bring down others, including Dennis Levine, an investment banker who had provided Boesky with inside information. The scandals revealed networks of illegal information sharing, where investment bankers, lawyers, and traders passed confidential information about upcoming deals to those who would pay for it or trade on it. These scandals damaged Wall Street's reputation, confirming suspicions that the game was rigged, that insiders were profiting from information unavailable to ordinary investors, that despite regulations the system remained fundamentally unfair. The prosecutions, led by Rudolph Giuliani as U.S. Attorney for the Southern District of New York, were aggressive and high-profile. The perp walks, arrested executives being led in handcuffs before cameras, became iconic images. The message was that white-collar crime would be punished, that Wall Street wasn't above the law. Yet despite the scandals and the excesses, Wall Street ended the 80s larger and more profitable than it had begun. The stock market, after recovering from the 87 crash, continued rising. The M&A business remained strong. New financial products continued to be developed. Wall Street firms expanded internationally, opening offices in London, Tokyo, Hong Kong, becoming truly global institutions. The partnership model continued to give way to public ownership. Goldman Sachs, the last major holdout, would go public in 1999, marking the end of an era. The growth of institutional investors, pension funds, mutual funds, insurance companies, was changing the nature of stock ownership. By the late 80s, these institutions owned more than half of all publicly traded stocks. This meant that Wall Street increasingly dealt with professional investors rather than individuals, with sophisticated buyers who demanded detailed analysis and competitive pricing. The retail investor, the individual buying a few hundred shares, was becoming less important to Wall Street's business model. The globalization of finance was perhaps the most significant long-term trend emerging in the 80s. Capital could now flow across borders with unprecedented ease. An investor in New York could buy stocks in Tokyo or London with a phone call. A company could raise capital in multiple countries simultaneously. Exchange rates, which had been fixed under the post-war Bretton Woods system until the early 70s, now floated freely, creating opportunities for currency trading and hedging. The world was becoming a single integrated financial market. This globalization created enormous opportunities but also new risks. A crisis in one country could now spread rapidly to others through interconnected financial markets. The 1994 Mexican peso crisis, where Mexico's currency collapsed and threatened default on dollar-denominated debt, required an international rescue package because American and European banks had substantial exposure. This pattern, local crises becoming global problems because of financial interconnection, would repeat in the Asian financial crisis of 97 to 98, the Russian default of 98, and eventually the global financial crisis of 2008. As we move toward the 90s and the new millennium, Wall Street stood transformed from what it had been at mid-century. The careful regulatory framework of the post-war era had been substantially dismantled. The conservative, relationship-focused culture had given way to aggressive deal-making and trading. Technology had changed how markets operated, how quickly information spread, how trades were executed. Globalization had created a worldwide marketplace for capital. Financial innovation had produced instruments of great complexity and sometimes great danger. Whether these changes represented progress or peril, whether the deregulatory movement had unleashed productive energy or dangerous excess, whether the balance between innovation and stability had been maintained or lost, these questions were being debated but not definitively answered. The market was functioning, profits were being made, wealth was being created. But vulnerabilities were building, risks accumulating, lessons from the past being forgotten or dismissed as irrelevant to the new era. Let's pause here, at the end of the 80s, with Wall Street having completed another transformation. Picture the trading floors, now computerized but still crowded with people shouting orders. Picture the investment bank's offices, young analysts at computer terminals modeling complex transactions. Picture the dealing rooms where currency and bond traders worked phones and screens simultaneously, moving millions with single calls. This was modern Wall Street. Fast, global, technology-driven, profitable, powerful, indispensable to modern capitalism, but also increasingly distant from the Main Street economy it was supposed to serve. The story continues forward through the dot-com boom and bust, through the housing bubble and the great financial crisis, through the transformations still ongoing. But we'll come to those. For now, rest if you need to. The narrative can wait. The history is patient. The rise of modern Wall Street, with all its innovation and all its problems, is there to be explored when you're ready. But there's no rush. Let your breathing slow. Let the weight of the day ease. We have time. We always have time. The 1990s brought another transformation to Wall Street, this one driven by technology in ways that were more profound and far-reaching than anything that had come before. The rise of the internet and the proliferation of personal computers changed not just how Wall Street operated, but what it was, who participated in it, what was possible. These changes would culminate in the dot-com bubble of the late 90s, a speculative frenzy that in some ways echoed the 1920s, but with its own distinctive characteristics shaped by the new technology. The early 90s saw the emergence of online trading. Previously, if you wanted to buy or sell stocks, you called a broker, who would execute the trade and charge a commission. Now, companies like E-Trade and Ameritrade offered the ability to trade through your computer, entering orders yourself without speaking to a broker. The commissions were much lower, sometimes as little as $10 or $20 per trade compared to hundreds for full-service brokers. This made active trading accessible to ordinary people in ways it had never been before. The democratization of trading that online brokers enabled was celebrated as empowering individual investors, giving them control over their own financial decisions, breaking the monopoly that traditional brokers had held. And there was truth to this. People could now research stocks using freely available information on the internet, make their own decisions, execute trades cheaply and quickly. They weren't dependent on brokers who might have conflicts of interest, or who might push particular stocks to earn higher commissions. But this democratization also created dangers. Many people who began trading online didn't really understand what they were doing. They confused the ease of clicking a mouse to buy a stock with actual investing wisdom. They made rapid trades, jumping in and out of positions based on tips from internet chat rooms or their own uninformed hunches. Day trading, buying and selling stocks within the same day, trying to profit from small price movements, became popular among people who had no business doing it, who were essentially gambling with money they couldn't afford to lose. The rise of financial news television, particularly CNBC, which had launched in 1989, accelerated this trend. CNBC provided constant market coverage, stock prices scrolling across the bottom of the screen, talking heads discussing the latest market moves, the sense that important things were happening every minute that required immediate attention and response. The channel became incredibly popular, watched in offices and trading rooms and increasingly in homes by people who were managing their own portfolios or day trading. This constant stream of market information and commentary created a sense of urgency, of the need to act, to trade, to not miss opportunities. It fed into a culture where investing became almost a spectator sport, where checking your portfolio multiple times a day became normal, where short-term price movements mattered more than long-term value. The patient, long-term investing that Warren Buffett advocated seemed boring compared to the excitement of rapid trading and the stories of people who had made fortunes quickly. The real transformation of the 90s, though, was the internet itself and the companies that emerged to commercialize it. The internet had existed in various forms since the 1960s, primarily used by academics and government researchers. But the development of the World Wide Web in the early 90s, the creation of web browsers like Netscape Navigator, and the increasing availability of personal computers and modems made the internet accessible to the general public. By the mid-90s, it was clear that the internet would be transformative, though exactly how wasn't yet obvious. What was obvious was that internet-related companies represented opportunity. Amazon, founded in 1994, demonstrated that you could sell books online. eBay, founded in 1995, showed that the internet could facilitate person-to-person commerce. Yahoo, Excite. And other search and portal sites attracted millions of users seeking to navigate the growing web. Entrepreneurs rushed to create internet companies, e-commerce sites, content sites, service providers, infrastructure companies, and venture capitalists rushed to fund them, believing they were investing in the future. Wall Street's role in this internet revolution came through initial public offerings, IPOs. Internet companies, most of which had never earned a profit and many of which had minimal revenue, wanted to raise capital by selling shares to the public. Investment banks underwrote these offerings, helping companies prepare prospectuses, setting initial share prices, finding buyers for the stock. The fees for IPO underwriting were substantial, typically 7% of the money raised, making this a very profitable business. Netscape's IPO in August 1995 is often cited as the beginning of the dot-com boom. Netscape, which made the Navigator web browser, went public at an offering price of $28 per share. On the first day of trading, the stock more than doubled, closing at $58. The company was valued at several billion dollars, despite having existed for barely a year and having uncertain prospects for profitability. The Netscape IPO demonstrated that investors had enormous appetite for internet stocks, that traditional valuation metrics didn't seem to apply, that getting in early on an internet company could generate spectacular returns. The pattern repeated hundreds of times over the next 5 years. A company with an internet business plan would get venture capital funding, would grow rapidly, would go public in an IPO that would see the stock price soar on the first day of trading. Early investors, the venture capitalists, the company founders and employees who had stock options, would become millionaires or billionaires, at least on paper. The investment banks that underwrote the IPOs would earn huge fees. And ordinary investors who bought the stocks, either in the IPO if they could get shares or in the market afterward, hoped to participate in the wealth creation. The valuations became increasingly disconnected from any rational basis. Companies were valued based on eyeballs, how many people visited their websites, or on revenue growth rates, without regard to whether they would ever be profitable. The idea was that internet businesses were fundamentally different, that old metrics didn't apply, that you needed to establish market position first and could figure out profitability later. Amazon went years without earning a profit, but its stock price kept rising because investors believed it was building a business that would eventually dominate retail. Some of the optimism was justified. The internet did transform commerce, communication, media, many aspects of life. Companies like Amazon, eBay, Google, which was founded in 1998, would become enormously valuable and would justify and exceed even aggressive valuations. But many internet companies had no real business, no path to profitability, no reason to exist except that internet companies were hot and could attract funding. Pets.com, which sold pet supplies online, went public in February 2000 and was out of business by November. Webvan, an online grocery delivery service, raised hundreds of millions of dollars and collapsed. Hundreds of companies with names ending in .com appeared and disappeared, leaving bankrupt shells and worthless stock certificates. Wall Street participated enthusiastically in this bubble, underwriting dubious IPOs, issuing research reports that hyped internet stocks, encouraging clients to buy. The conflicts of interest were blatant. Investment banks earned fees from underwriting, so they had incentive to bring companies public regardless of quality. Their research analysts were supposed to provide independent analysis, but were under pressure to issue positive ratings on stocks to help the underwriting business and to maintain relationships with company management. Analysts became celebrities, their recommendations moving stock prices, their appearances on CNBC watched by millions. Henry Blodgett, an analyst at Merrill Lynch who covered internet stocks, became famous for his optimistic price targets and buy recommendations on companies that were obviously overvalued. Jack Grubman at Salomon Smith Barney did similar work covering telecom companies. These analysts were paid millions in compensation, but their research was deeply compromised. After the bubble burst, investigations would reveal that analysts privately expressed skepticism or contempt for stocks they were publicly recommending. That research was explicitly being used to win investment banking business, that the Chinese wall that was supposed to separate research from banking had broken down entirely. The Federal Reserve, under Chairman Alan Greenspan, watched the stock market rise through the late 90s with concern, but took limited action to restrain it. Greenspan gave a famous speech in December 1996 warning about quote_12 in stock prices. But the warning was ignored and the market kept rising. The Fed's main tool for influencing the economy was interest rates, but raising rates to slow stock market speculation might also slow the real economy, potentially causing a recession. The Fed chose to let the bubble continue, hoping for a soft landing or perhaps believing that the new internet economy really did justify higher valuations. By early 2000, the stock market, particularly the technology-heavy Nasdaq index, had reached levels that were clearly unsustainable. The Nasdaq Composite Index, which had been under 500 in 1990, peaked at over 5,000 in March 2000, more than a tenfold increase in a decade. Individual internet stocks had appreciated even more dramatically. Amazon had risen from $18 at its 1997 IPO to over $100. Cisco Systems, which made networking equipment for the internet, briefly became the world's most valuable company, worth more than $500 billion. The bubble began to deflate in the spring of 2000. There was no single dramatic crash like October 1929 or October 1987. Instead, prices began to fall irregularly at first, with rallies that gave hope before selling resumed. Some internet companies began running out of cash and shutting down. Others announced disappointing results or reduced projections for future growth. The realization began to spread that many internet companies would never be profitable, that the business models didn't work, that the valuations had been absurd. The decline accelerated through 2000 and into 2001. The Nasdaq fell from its March 2000 peak of over 5,000 to below 1,200 by October 2002, a decline of more than 75%. Trillions of dollars in market value evaporated. Thousands of internet companies failed. The broader stock market declined as well, though less severely than the Nasdaq. The Dow and S&P 500 both fell substantially, entering what's technically defined as a bear market, a decline of 20% or more from peak. The bursting of the dot-com bubble destroyed enormous amounts of wealth and caused real economic damage. People who had invested heavily in internet stocks, including many employees of internet companies who held stock options, saw their paper wealth disappear. Some people lost life savings. Retirement accounts that had been heavily invested in technology stocks were devastated. The broader economy went into recession in 2001, a relatively mild recession, but real nonetheless. With unemployment rising and economic growth stalling, Wall Street firms suffered as well. The investment banking business dried up as IPOs essentially stopped. No one wanted to buy stock in new internet companies after so many had failed. Trading commissions fell as investors pulled back from the market. Some firms that had been most aggressive in internet banking faced legal problems and reputational damage. The scandals over compromised research led to a regulatory settlement in 2000. 3, where major firms paid $1.4 billion in fines and agreed to separate research from investment banking more rigorously. But the dot-com bust, painful as it was, didn't cause a systemic financial crisis. Banks didn't fail. The payment system continued to function. The regulatory framework held. The Federal Reserve cut interest rates aggressively, providing stimulus to help the economy recover. By 2003, the economy was growing again. The stock market began to recover. The crisis had been contained, managed, prevented from becoming a true catastrophe. Yet even as the dot-com bubble was deflating, another bubble was beginning to inflate in a different asset class. Real estate. The Fed's aggressive interest rate cuts in response to the dot-com bust and the September 11, 2001 terrorist attacks brought mortgage rates to historic lows. Housing prices began to rise in many markets. Mortgage lending expanded, with new types of mortgages being offered to borrowers who previously wouldn't have qualified. The seeds of the next crisis were being planted even as the last one was being resolved. Wall Street's role in the dot-com bubble raised questions that would become more urgent during the housing bubble and financial crisis that followed. Had Wall Street become too focused on short-term profits at the expense of long-term stability? Had deregulation gone too far, allowing conflicts of interest and risky behavior that harmed clients and the broader economy? Had the complexity of modern finance created opacity that hid risks and enabled fraud? These weren't new questions, they echoed concerns from the 1920s and earlier eras, but they were asked with renewed urgency. The Glass-Steagall Act, which had separated commercial and investment banking since 1933, was finally repealed in 1999 with the passage of the Gramm-Leach-Bliley Act. This allowed commercial banks to merge with investment banks, to engage in securities underwriting and dealing, to combine businesses that had been kept separate for 2/3 of a century. The justification was that the separation was outdated, that it prevented American banks from competing with European universal banks, that modern risk management techniques made the separation unnecessary. The repeal of Glass-Steagall symbolized the triumph of deregulation, the belief that the Depression-era restrictions were no longer needed, that markets could police themselves, that innovation should be encouraged rather than constrained. Critics argued that the separation had served an important purpose, that combining commercial and investment banking created too big-to-fail institutions that would require government bailout if they got into trouble, that the Depression-era reformers had understood something important that was being forgotten. The debate would continue, but the direction was clear, toward less regulation, more freedom, more risk. As the new millennium arrived, Wall Street had achieved a level of power and influence that exceeded anything in its history. The major investment banks were now global institutions operating in dozens of countries, handling trillions of dollars in transactions, employing hundreds of thousands of people. They were deeply integrated into the world economy, essential to how capital was raised and allocated, how corporations financed themselves and pursued growth, how governments funded operations and managed debt. But with this power came responsibility that wasn't always acknowledged or met. When Wall Street failed, when it enabled bubbles or engaged in reckless behavior, the consequences weren't limited to Wall Street. They spread through the economy, affecting millions of people who had never traded a stock or bought a bond. The firefighter in Ohio whose pension fund lost value when internet stocks crashed. The family in Florida whose home would be foreclosed when the housing bubble burst. The recent college graduate who couldn't find a job because the financial crisis triggered a recession. Wall Street's actions had consequences far beyond Lower Manhattan. The question facing Wall Street and American society as we moved into the 2000s was whether the lessons of past crises had been learned or forgotten, whether the regulatory framework would be maintained and strengthened or further dismantled, whether the balance between innovation and stability could be preserved. The answer would come in the form of the housing bubble and the financial crisis of 2007 to 2009, the worst financial catastrophe since the Great Depression, A crisis that would once again force fundamental questions about how Wall Street operates and what its role in society should be. Let's pause here, in the early 2000s. With the dot-com bubble deflated but the housing bubble inflating, with Wall Street seemingly triumphant but vulnerable in ways not yet fully visible. Picture the trading floors now dominated by computer screens, the old open outcry trading largely replaced by electronic execution. Picture the investment banks' gleaming office towers, filled with quantitative analysts creating complex mathematical models, with traders managing enormous positions, with bankers structuring deals worth billions. Picture the millions of Americans with retirement accounts invested in mutual funds, depending on Wall Street to help them build financial security, trusting in a system that would soon betray that trust. The story of Wall Street continues beyond this point. Through the housing crisis, through the regulatory responses, through the ongoing evolution toward an increasingly electronic, global, complex financial system. But we'll come to that. For now, rest if you need to. The narrative can wait. The history is patient. Wall Street's journey from buttonwood tree to global power, with all its triumphs and disasters, its innovations and excesses, its essential functions and dangerous dysfunctions, that story is there, waiting to be concluded when you're ready. But there's no rush. Let yourself drift. Let the weight of the day ease away. We have time. The past can wait, and so can the future. Rest now. And so we've travelled together through more than 2 centuries of Wall Street's story, from a buttonwood tree to a global force that shapes economies and lives across the world. We've watched ambition build markets, watched excess create bubbles, watched crisis force change, watched resilience bring renewal. We've seen that human nature doesn't really change. The greed and fear, the innovation and manipulation, the dreams of wealth and the reality of risk, these constants run through every era from the 1800s to today. If you found value in this slow drift through financial history, through the cycles of boom and bust, through the human stories behind the statistics, I hope you'll consider liking and subscribing. And to those who are already part of this community of thoughtful listeners, thank you for being here, for sharing these quiet explorations of how we've organized our economic lives. Wherever you are right now, in whatever corner of the world you're watching from, you're part of this continuing story. The markets open tomorrow, the wheels of commerce keep turning, the search for prosperity, for security, for meaning in our work and our exchanges, that continues. But tonight, you can rest from all of that. You can let it all go. Wall Street will still be there in the morning, that narrow street in Manhattan, symbol of so much hope and fear, innovation and excess, power and vulnerability. But right now, it doesn't matter. Right now, there's just this moment, this breath, this gentle settling into sleep. Let your eyes close if they haven't already. Let your thoughts drift like ticker tape floating down through the air, settling softly, becoming still. The past has taught us what it can. The future will arrive whether we worry about it or not. For now, there's only this quiet darkness, this peaceful letting go. Sleep well, dream gently. Good night.